crashes at 9.1% as the Treasury curve inverts to levels not seen since 2000. King dollar pummels the euro to parity. Jumbo hike in play. Markets see a 50-50 chance of an historic 100 basis point move as inflation piles pressure on the Fed. Plus, rebound on the ropes. Draft projections show the EU slashing its GDP forecast amid surging prices and an energy crisis. Let's check in on the futures then as investors hearing you're way up. That red-hot inflation print out of the US, of course, and now expectations that you could well get 1% on July the 26th from the Fed and the FOMC. The FTSE 100 currently lower by about 0.1%. Of course, it will take some time for these markets to really settle into position. We're also looking at Italy and the idea that maybe that stability of the technocrat Mario Draghi is starting to crumble, his coalition at risk. There is what is essentially a confidence vote later today in the Italian parliament. So watch that. BTP is already trading lower, yields up on Italian debt. Spanish IBEX currently down 0.6%. The CAC Quarante lower by 20 points, down 0.3%. Here in the UK as well, we continue to watch the fallout, at least the jockeying amongst those hoping to take over as leader of the Conservative Party and, of course, of the UK as Prime Minister. Let's switch it over and see how things then are playing out cross-asset. You had a relatively muted response after a very volatile session, closing lower just around 0.4%, just down 0.1%, in fact, for the Nasdaq. So those tech-heavy index performing slightly less badly than the rest of the broader market stateside, despite that very high inflation print. And again, expectations that you're going to get an increasingly aggressive Fed. But are they going to essentially pile in the rate hikes early, and that allows them to cut? The markets are pricing in cuts in 2023. Future stateside pointing to losses of 0.3%. The 2-year, and that inversion between the 2s and 10s is pronounced, as we said, the most inverted across that yield curve since around 2000. Currently at 3.20 on the 2-year. Euro dollar crossing below parity yesterday, currently just flirting with that level once again, down 0.5%. Keep an eye on the yen as well, certainly under pressure, the Japanese currency. Brent is at $99 a barrel, below 100, lower by 0.5%. President Biden in the Middle East, of course, wanting to pressure certainly the Saudis to try and release more oil onto the markets. Whether or not they can actually do that is another question. Joining me on set is Bloomberg Intelligence Chief Equity Strategist Gina Martin-Adams. And Gina, let's start with where your views are on the CPI print and where it leaves equity markets stateside, and the fact that they seem to take this on the chin to some extent.
Yeah, I think you hit the nail on the head there. It really was a very muted response to a very aggressive CPI number, and you can't help but wonder if that's simply because the market has now become sort of used to the very fast inflation prints. Certainly what we've seen in the analysts' forecast is a very rapid reduction in operating margin estimates, which would reflect an anticipation of very strong inflation, stronger for longer, stickier inflation. And maybe that's what we saw yesterday, frankly, is the market was relatively well prepared for this.
So the market becoming somewhat immune to these higher than expected inflation prints. The Fed Beige Book as well, pointing to maybe in some areas at least, some of these price pressures cooling off, but increased concerns around recession. Let's go over to Bloomberg M Live Managing Editor Mark Cudmore then. And Mark, you're looking at financial conditions.
Yeah, absolutely, Tom. I'm going to give yourself and Gina another reason why stocks might be doing okay. I'm going to point out that actually financial conditions are exceptionally accommodative still, despite the fact that we're in the most inflationary environment seen in more than 40 years. So there are several different ways of measuring financial conditions. It's a little bit subjective. You've got many different inputs. It's not just the Fed benchmark rate. It's also the yield curve. It's the dollar. It's asset prices, etc. So first of all, here's the Goldman measure of financial conditions. Now, for the Goldman measure, it's a little bit confusing because they do it the opposite way around. Below this line means we've got easy financial conditions. Above this line means we've got tighter financial conditions. This line being the average in its entire history, going back to 1982. And you can see we are still much easier than the average financial conditions we've seen in the last 40 years, according to the Goldman Index, despite aggressive tightening recently. But it's tightening from the record level of easiness. So we're a long way from tight financial conditions over the average. And if you note, the one period when we did have tight financial conditions in the Goldman Index was back in the 80s when we had really, really high inflation, whereas most of the past decade was very, very easy. Now I'm going to go to the next chart, which is the Bloomberg measure of financial conditions. This was built much more recently. Its history goes back to 1990. I actually think it's a little bit better one, but the people have different views in this. This average is pretty close to zero, showing how well it is. And you can see that on this one now, a little bit confusing, the Bloomberg one works the opposite way around. So on this one, when it's below the line, we're tight financial conditions. Above the line, it's easy financial conditions. On the Bloomberg one, we moved into tight financial conditions about 6 months ago, and we were just slightly tighter than average of the last 32 years. But nothing dramatic. Now, the final one I want to show you, and why I think stocks are still doing okay, the final chart is the Bloomberg Financial Conditions Plus Index. And what this is the kind of standard measure, like both Goldman and Bloomberg use, plus adding in some speculative assets, housing market, tech stocks, etc. Basically saying that those assets are really important for consumer wealth and therefore financial conditions. And it is saying that despite aggressive tightening, we are still way, way looser financial conditions than any time in the last 32 years since the pandemic, so since before the pandemic. So basically, we have a long way to go to get tight financial conditions, and this is my premise of why the Fed is going to have to hike rates much more than it's priced, and that's why the real pain for stocks is probably 6 or 9 months away.
Okay, but for now at least, in the immediacy, some support there for stocks, at least from what is historically relatively still decent in terms of easy monetary conditions. Just been outlined there in terms of the context from managing editor, MLive managing editor Mark Cudmore. But more pain ahead, longer term, for stocks as those conditions tighten. Thank you, Mark. Some breaking news across the terminal right now. It's a redhead across your terminal. China considering ending Australian coal ban on Russian supply fears. This is important. China put in essentially a ban on Australian coal after the previous Australian government called for an investigation into the origins of COVID. Just one of a number of measures that Beijing put in place to punish Australia over that. Now, China considering ending that ban. Of course, coking coal from Australia has the quality that's needed, particularly around the production of iron ore that China lacks. So we'll continue to watch that. And again, it really underscores just the constraints within the commodity space and the measures, certainly that China is looking to put in place to address some of those, even if it means reducing some of the punishment that it meted out on Australia, again, over that original calls for an investigation into the origins of COVID. Okay, US inflation hit 9.1% in the year to June. That is another 40-year high. That is likely to strengthen the Fed's resolve to stay on its aggressive hiking path and make another jumbo increase in July. The question now being whether the US central bank raises by 75 or indeed 100 basis points.
This inflation print, it's a problem.
This was a very hot report.
There's no slowdown in inflation here.
Domestic price pressures are still quite strong.
This is going to amp up pressure on policymakers.
This keeps pressure on the Fed to keep going.
It needs to keep moving at a rapid clip.
We still think they go 75 in July.
The Fed probably will go 75 basis points.
It's going to be very difficult to get off 75 basis point hikes.
This morning's report seems to solidify that 75 basis points.
But I think they really ought to be careful here because this is actually turning.
These rate rises are coming as growth is starting to slow.
They can't respond to slowing growth. We know growth is slowing, but I think they're going to just keep going.
And that's a real concern.
Tightening policy into slowing growth is just not a good combo for risk assets.
They can slow down the pace, but I don't think they're anywhere close to stopping.
Okay, let's get into the key market drivers now. Joining us is Eleanor Taylor-Jollard, co-head of Swiss and Global Equity at UBP. Also with us is Bloomberg's Justina Lee in the studio. Justina, let's start with you then. What is the credibility risk for a Fed that goes 100 basis points? Can they look through that, given the inflation print that we're seeing?
Right, exactly. I mean, for a long time, people were just expecting a 75 basis point, rate hike. But we've kind of seen like a pretty worrying CPI print yesterday, because not only did it beat expectations, we see those inflationary pressures broadening beyond, the previous categories, including, showing up in shelter, showing up in rent, which is a big chunk of the CPI index. And so I think what the Fed is really worried about is anchoring those expectations, especially now that we're starting to see consumer confidence getting hit as well.
Talk to us, Justina, about what this might mean for the ECB and how the ECB may be caught in this mix of the Fed increasing rates faster, the dollar surging, the euro crashing relative to the dollar, but growth even decelerating more here with fast inflation.
Yeah, exactly. I mean, the ECB has always been a bit slower than the Fed. I mean, the economy is sort of not doing as well as the American economy. But at the same time, I mean, they're also grappling with those inflationary pressures. They're even more reliant on Russia for energy. But it also has hit a bit of a snag because of concerns over fragmentation. And I think, that's even more relevant now with the headlines coming out of Italy about kind of Italian politics. I mean, how are you going to keep that spread, between Italian bond yields and German bond yields in check?
And that spread back in focus, as you say, yields up about 13 basis points in the Italian BTP 2-year, the 10-year up close to 12 basis points. Eleanor, let's bring you in at this point. Eleanor Taylor-Jollidan, co-head Swiss and Global Equity at UBP. Eleanor, let's get you to throw your hat in the ring then on this question of 100 basis points. Do you think the Fed goes that far?
I wouldn't be surprised. I mean, in some ways, we're absolutely where we were last month, in fact, where just a few days before the Fed was going to rise, we suddenly were expecting and hearing a few whispers about 100 basis points. And certainly we were moving very much away from the 50 basis points, which had previously been expected. I think that looking at the language from the Fed at the moment, they are wanting also to show that they are very, very clear about keeping a cap on inflation. When you see how the markets are reacting at the moment, indeed, there seems to be a willingness to go further faster in order to say this is done now, and then to move on and concentrate once again on fundamentals of stocks.
Eleanor, one thing that my team talks about a lot is sort of the nature of this particular crisis being so different than crises of the past, and it's really turned country strategy on its head in the global equity markets. Talk to us about how you navigate your country allocation in this climate.
Well, for us, in any case, country allocation is actually very much a secondary concern because companies today are global companies, and the kind of companies that we concentrate on, which are able to generate improving or high cash flow returns on investment, need to be positioned towards end markets which show growth. So we're never going to allocate to an individual country. We are always going to do stock picking and allocate to companies which have growth opportunities ahead and have an ability to navigate more difficult economic conditions. Having said that, there are some countries which are very well positioned in situations where the markets are more volatile, where there are more question marks. And once again, I would draw attention to Switzerland. In this case, you've seen much less of a multiple compression in Switzerland than you've seen in other countries, only 14% against 17% for global equity. And that is, again, a sign which this is a company which is a country which is expected to navigate more easily some of the tensions that we have around us today.
Okay, so you talk about country selection becoming sort of secondary to company selection. When you dig into those companies and you think about cash flow growth, it's pretty clear that so far this year, the companies with very strong long-term cash flow growth have underperformed materially. Is now the time to move back into those companies with long-term cash flow growth, or are you more focused on sort of short duration companies in your portfolio?
Well, when we look indeed at those higher quality companies, they're the ones that are indeed throwing off cash more easily than some other companies. They have been hit by a very strong multiple compression. There was very much a trend, I would say, during the pandemic, for obvious reasons, to concentrate on companies which can continue to function, continue to generate cash, despite the pandemic, and the valuations were beginning to be much higher than other companies in the market at the end of 2021. So there has been a lot of multiple compression there. And multiple compression there, why? Because actually the earnings themselves have not moved very much. We're still expecting something like 7% earnings growth for the global equity markets in general, 10% for Swiss equity indeed. And again, that earnings growth is going to come from those cash generating companies, and those companies which continue to have strong demand in end markets and are less affected by some of the shocks to the oil price and gas price because they are better diversified, less dependent, less capital intensive than some of their peers.
Justina, let's bring you in at this point. What are you and the team going to be scrutinising this earnings season? Which sectors are looking most vulnerable then to earnings downgrades?
Yeah, that's a good question because, usually we see analysts acting with a lag here, and sort of that's exactly what is happening here. I mean, earnings expectations haven't really been going down as fast. I think a lot of people will be seeing, how strongly are kind of those margins holding up? How strongly are kind of the consumer sectors, which may be dependent on, stimulus spending and consumers being in a good health? And of course, maybe we'll get some support from, the energy sector and kind of what's happening with tech, because their kind of multiples have come down, but will we see still resilient earnings growth in that area as we have kind of over the past decade?
Yeah, and will the relative retreat in the 10-year, the long end of the curve, give some support maybe to growth stocks as well after the derating that we've seen? Justina Lee, thank you very much indeed, of course, from our MLive team. And Eleanor Taylor-Jollard, co-head Swiss and Global Equity at UBP. Coming up, the European Commission is expected to revise down its growth projections for the single currency area. We have that exclusive story next. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Welcome back to the Open. We're 18 minutes into your European trading day. Losses across European equities are 0.2% as investors weigh up the likelihood or not of a 1% hike from the Fed come July the 26th on the back of that 9.1% inflation print. You've got the Italian political situation as well under scrutiny. In fact, the Italian stocks leading the losses down around 1%, and BTPs as well. Sell off in Italian debt. Just briefly getting up to speed what's happening there. The 10-year at 328 on BTPs. A yield jump of 14 basis points. And talking of Europe, draft projections by the European Commission show a much weaker than expected rebound from the pandemic. Inflation in the region is expected to be faster than previous forecasts. Joining us now is Zoe Schneeweiss, who is Bloomberg's Western Europe economy editor. Zoe, the new forecasts are out. Just how bad is the situation then in Europe?
So this year's GDP numbers look fairly similar to what they were 2 months ago, where you see the real howler is next year, where the Commission will say that growth is only expected at 1.4%. That's a very, very weak number. On inflation, they've massively revised up both this year and next year's number. This year they're expecting at 7.6% average, and next year they're expecting 4%, both very, very strong readings. We already, in a way, had a bit of a teaser of this a month ago when we got the economic forecast from the ECB. There, though, the difference is we have an extra month of inflation data, and those are only going up, and that obviously is very bad news.
Zoe, what will this mean for the ECB and policymaking going forward?
So we are just a week ahead of the first rate hike in more than a decade. That's next Thursday, where everyone is expecting quite clearly that there'll be a 25 basis point rate hike. That will set the stage for, was supposed to set the stage for a series of rate hikes. The next meeting after that is September, where generally they think a 50 basis point rate hike should be happening. And then after that, gradual rate hikes. Markets do expect at least 25 basis points at each of the coming meetings. The question, though, is how far can this go? And in the current situation, where we have now where the GDP numbers are not looking great, where there's the danger of a cutoff of Russian gas, could that mean that there's a recession threat? And if there's a recession threat, will they actually manage to continue hiking rates? That's the big question here.
Also, I mean, to that point, we're getting arguably clarity from the Fed in terms of where their priority is. It's around tackling inflation versus employment. Do we have such clarity from the ECB? They're behind the curve, many would argue. Do we have clarity on where their priority lies at this point?
In a way, we have an easier situation at the ECB because unlike the Fed, they don't have a dual mandate. Their mandate is price stability. The issue, though, is we're dealing with a region of 19 different economies. From next year, it even will be 20 different economies when Croatia joins. So you have different interests here. And as rates rise, this will have an effect on yields. And you already addressed the crisis in Italy. This obviously is something that might stop them from being able to hike rates. Overall, the reason why the reason the ECB has given why they've waited so long is it takes 18 to 24 months for any rate hike to feed through. So they thought they could wait just a little bit longer. The danger now is that they might have waited just a tad too long.
Yeah, fragmentation risks as well, as you highlighted. Zoe Schneeweiss, Bloomberg's Western Europe economy editor with the best shirt in Frankfurt. Thank you. Coming up, S&P 500 financials are set to kick off earnings season amid continued recession risk. We discuss that next. This is Bloomberg.
Happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open. We are 24 minutes into European trading day. Losses across European equities of 0.1%, pairing some of the heavier moves. But the futures stateside after a very volatile day, of course, on the back of that 9.1% CPI print. Currently, S&P E-minis pointing down by 0.4%. Nasdaq futures in exactly the same territory as well. Let's check in on some stocks on the move at the Open. We've got Ericsson, of course, the telecoms infrastructure and equipment maker, coming out with a second quarter operating profit miss. Sales were a beat, but margins were a big miss for Ericsson, and of course investors reacting pretty aggressively to that. The stock down 9% in the session so far. Deutsche Telekom, this is a story that's been in the works, selling off part of its towers business, 51% stake to Brookfield Group for about 11 billion euros, currently down 0.9%. They want to pay down some of their debt. SEB, the biggest Swedish lender, currently gaining 2% on the back of a beat when it comes to their second quarter results, driven by high lending volumes and, of course, the rate hikes that we've had from the National Bank over there in Sweden. Sweden's largest bank, gaining there around 2%. Talking of the banking sector, we've also got Wall Street bank earnings kicking off, and who better to talk us through that than Bloomberg Intelligence's chief equity strategist, Gina Martin-Adams. Gina, we start, of course, by looking at the likes of SEB. Trading volumes are up. They've had the rate hikes. Those conditions clearly at play as well for US banks, but then the recession and growth fears. Right. So how do those factors play into where these banks stand, given that you've seen losses of between 20 and 30% across most of the US big names?
I think that's the key, is we've priced in so much risk. How bad can it be is a really big question. I'd say the one factor that could indicate things are actually quite a bit worse is if banks start suggesting there are charge-off increases, if they actually start charging bad credit. Then it's a big problem. But for now, analysts are already expecting a pretty big increase in loan loss provisions. They're expecting a very damp margin outlook. They're not expecting much by way of loan growth. So it would seem that companies are pretty set up to beat expectations, at least on the second quarter. The real risk is what's going to happen into the outlook.
It's further out. So a lot is priced in at this point. We look ahead, of course, to the US banking earnings out later this week. Gina Martin-Adams, the report is there on the Bloomberg from her and the team at Bloomberg Intelligence. Well worth digging into ahead of those earnings. Coming up, Russia keeps European traders on edge about the return of the Nord Stream pipeline. We will get details and analysis on the potential implications next. Stay with us. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. it means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to The Open. We are 30 minutes into the European trading day, and here are your top stories. US CPI scorches at 9.1%. That's as the Treasury curve inverts to levels not seen since 2000. King dollar once again pummels the euro, this time to parity. Jumbo hike in play. Markets see a 50-50 chance of an historic 100 basis point move as inflation piles pressure on the Fed. Plus, rebound on the ropes. Draft projections show the EU slashing its GDP forecast amid surging prices and an energy crisis. Let's check in then on these markets. Investors weigh up an ever more aggressive Federal Reserve. You saw the Bank of Canada coming out and saying, we need to front load with a surprise 1% move. Will we get a same thing again from the Federal Reserve later this month? The markets, as we said in the headlines, pricing in a 50% chance of that. But if you front load the rate hikes, does that mean you get cuts next year? And then, if that is your thesis, how do you position around that? The European Stock 600 currently down just 0.1%, pairing some of the heavier losses. We have the politics of Italy at play. Mario Draghi at risk as that pillar of stability. The technocrat has threatened to walk away if the five-star movement doesn't get involved in what is essentially a confidence vote later today. And the five-star movement has said they will not be part of that vote. So continue to watch Italian politics. BTP's on the move as a result of that debt being sold off. The DAX is currently gaining 0.2%. Autos are back in play. That is a factor that's supporting the German market. The FTSE 100 down by about 0.1%. We continue to look at basic resources and commodities. Iron ore once again off today. Again, the concerns around China, the demand, and broadly recession risks. Let's switch it on, see how things are playing out across these sectors then. 32 minutes into today's trading day this Thursday. We're going to take a look at those sectors again. As I mentioned, autos, that's been under pressure the last few days, coming back at least around the margins. That's supporting the DAX. At the top of the list, though, you have travel and leisure gaining 1.3%, autos gaining around 1%, media also up by about 0.5%, so pretty modest gains there for that sector. At the bottom of the list, telecoms, real estate and utilities, so some of the more safe haven traditional sectors. That is the picture currently. Continue to watch euro dollar, of course. It crossed through parity yesterday. King dollar back in focus, up 0.4%, and the yen as well, taking a bit of a punch to the gut today. 138. Did we get to 140 in the next day or so? Currently down a little over 1% for the Japanese currency. The rate differential is very pronounced indeed. Now, we were talking with Gina Martin-Adams, of course, from BI, our chief strategists, about the financial sector. Gina, what are you thinking about more broadly when it comes to earnings, and how much fragmentation, how much divergence you're going to see within the earnings picture when we look, for example, at retailers and the question of inventories versus the banks, and whether or not, for example, as you said before the break, that a lot of this maybe is already priced in. How much divergence do we expect to see in these earnings as we look ahead to potential downgrades?
Actually, record divergence between growth and value sector earnings. It's really quite stunning. When you look at the broad market, you've got growth sector earnings plummeting double digits, value sector earnings actually rising nearly double digits. That divergence is fairly remarkable relative to the past. So we should see a record there and a slow reversal coming over the next 4 quarters. The other thing I think is really underappreciated is this is the toughest comp of the cycle. So analysts are expecting actually the second quarter to be trough earnings growth, which really flies in the face of logic when you think about it, is everyone's anticipating slower economic conditions to emerge over the next 4 quarters. But because we're comparing to such extreme growth a year ago, this might actually be trough earnings. And if we can continue to see energy sector, industrial sector, materials sector earnings post reasonable growth, earnings may accelerate into the second half. It's just bizarre. It's a weird cycle by any stretch of the imagination. but that's what's embedded in analyst forecasts.
It's pretty fascinating. You just look back to 2021 when the analysts, and we kept missing the extent to which they were upgrading. The analysts were behind the curve in terms of upgrading. This time the concern is they're behind the curve in terms of cutting those downgrades or cutting those views, of course, on sectors and companies. But over the next few quarters, things could change markedly, and potentially we're looking at a trough because of the comparisons. That's fascinating. Let's talk about one sector, of course, that's playing into this key when it comes to inflation, but of course the support that you've seen across value is energy. And let's bring in then, and let's just talk more broadly, give the context. Europe's energy crisis, of course, Russia keeping natural gas traders on edge about the return of Nord Stream pipeline. Will it actually come back with maintenance due to end next week, at least in theory? Our next guest is Sarah Vakshuri, who is president and founder of SVB Energy International. Sarah has 2 decades of experience working in the energy industry. She's consulted numerous governments and international organizations, including the IMF and the World Bank, on energy strategies. Also a professor of energy security at the Institute of World Politics. I think we just read out most of your CV there, Sarah, and it is a very solid CV indeed. So thank you very much for coming into the studio. Let's talk about the risks then. And we heard from the French finance minister over the weekend that the default in Europe should be, the assumption should be that that gas doesn't come back online. The European Commissioner, who we spoke to earlier this week on energy, said that prices and the situation is likely to get worse before it gets better. What will the material impact be if that Nord Stream gas doesn't come back online? And where is Europe in terms of building out its ability to sustain itself as we head into winter?
That's a good question. Just to answer the last question first about where the Europe is, it's really how we distinguish between short-term and long-term. In a short-term, obviously, unfortunately, there's no quick fix. What we are seeing is that the coal prices and oil and coal consumption both are increasing, and some of the companies and industries in Europe are switching to oil. Even in Asia, we see that coal prices are increasing. The reason for that is that they're expecting that there is a shortage of gas, especially in fall and winter, and they're getting ready to be in a second priority to receive gas. Obviously, the consumers and households are the priority when it comes in terms of gas for power generation. So industries are switching away from natural gas, at least for the fall and winter. In the long term, obviously, the story is different. The alternative sources, suppliers to Russian gas, we could look at US or other LNG exporters, but also different sources of energy like nuclear, renewable, just whatever it takes to reduce that dependency to Europe.
When you think about that long-term transition, where are the winners? What sources of energy do you anticipate to really take the greatest degree of market share? Because there's such a debate going on. And in particular, over the course of the last few weeks, I've heard a lot of clients talking about wind as really just not the answer. Would you disagree? And what can we look forward to over the next decade?
As of now, with technologies that we are looking at this moment that we are talking, wind and solar could not be the real ultimate answer. Nuclear could be a solution, but if you look at the nuclear, Russia is, again, a winner because if you look at the market share of Russia and also China, when it comes to nuclear technologies and also all the stages of transforming the uranium all the way to fuel, enriching it, converting it to fuel, still Russia has a significant role. Yes, France and some other countries, US, have some strength in terms of technology, but still when it comes to fuel and also technologies, assets, Russia has a higher hand. When it comes to mining, China has a very important role. You see that many like countries like Namibia, they're one of the largest, they're hosting the largest uranium mines, and China is controlling, and also Russia. So as now the European Union is considering nuclear as a green energy, it's very important for countries like US, European countries, France, to be more active, both for the geopolitics of this transition, but also for importance of those regulations, because obviously China and Russia have a much more flexible regulation when it comes to nuclear energy, but also, again, that's the dependency we are talking about, transit.
And Macron, French politicians making the case, of course, given the strength of their own industry. In terms of the here and now then, and OPEC and its ability to meet and at least get to a point where it can be pumping more, and we've talked about the lack of investment. Biden is in the region. Is this a mission that's already failed? What can he possibly achieve when OPEC have made it perfectly clear that they do not have additional capacity?
Yes, they made it clear. Also, other countries, like we had Macron saying that too, so other European leaders communicating with OPEC producers. There are some spare capacity in Saudi Arabia, but we cannot expect OPEC to release everything it has, because they usually traditionally maintain some spare capacity for the time of sudden emergency or interruption in the market. But also what they are arguing, and they have been arguing from beginning, OPEC, was that Russia's oil export is so significant that we cannot really cover for Russia's export. The only capacity that we could think OPEC has, that would be Venezuelan and Iranian sanctioned oil. And for that oil to be released, that requires a whole different dynamics of political and policy change, at least in Washington, D.C. Now that Iran is in nuclear discussions with the West, we don't see a close prospects for that.
Sarah, we've got so many questions we could be asking. We need to get you back on because we're running out of time. This is a lot to fit into 1 hour. But thank you very much for coming onto the studio with your analysis, given all of your experience, of course. Thank you very much. Sarah Bagshuri, President and founder of SVB Energy International. Of course, energy ties into what's happening in Italy. And in that country, the coalition government is at risk of collapse over a dispute on a key aid package vote. Joining us now is Bloomberg's Milan bureau chief, Tommaso Erpart. Tommaso, is Italy really on the brink of a government crisis? We've become used to, and this sounds strange to say, political stability in Italy with Mario Draghi at the helm as the technocrat.
Yes, buongiorno. That time of stability might be over soon. The five-star movement, which is now the second biggest party in Draghi's coalition, has decided not to vote confidence to the government today in a key vote. The vote is on an aid package. The five-star led by former Prime Minister Conte somehow are against the plan in terms of some of the aspects of the plan. They want more deficit, they want more aids for the families. They are essentially against Draghi's line. Also, most of them are against Draghi's line on the Ukraine invasion. They don't want Italy to send more weapons to Ukraine. There's various reasons why they're against this plan. One is also a waste-to-energy plant that Italy will install in Rome, and the five-star movement and against it. All those reasons are bringing them not to vote the confidence to the government this morning, and that means that Mario Draghi may go to the president as early as today to offer him resignation. So, yes, we might be close to instability.
So, Tommaso, tell us then what happens next after the vote occurs. If Draghi does ultimately resign, what are the next steps here?
So we are waiting to see the outcome of the vote. The government will have enough vote to get the confidence of the parliament, but Draghi has said, if the five-star won't vote for me, then my government is over. So Draghi will likely go to the president today, offer him resignation. The president might tell Draghi, maybe go and have a look if your coalition is still there or not. So there could be another round of talks before Draghi decides if really resigning or not. We will see in the next hours. It's very frantic, the situation here, what could happen. But clearly, this is probably the highest tension we have seen since Draghi took the job in February 2021.
The highest tension since Draghi took the job. Milan's bureau chief, Tommaso Erpart, with the excellence there on the political risks bubbling up in Italy. Thank you. And the Italian FTSE MIB is the clear outperformer, currently down 1.3%. And in terms of the bonds, there is a significant sell-off in BTPs. Yields up 17 basis points on the Italian 10-year, currently at 332. Coming up, China's property bond market enters a new phase of distress. More on that story next. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Welcome back to the Open. 46 minutes into the European trading day, losses of 0.3% across European equities. Let's turn to China now and the property crisis in the world's second largest economy. A debt sell-off is expanding from weak private developers to usually healthier state-backed firms, and it is threatening to spread financial risk beyond the debt-laden property sector. Let's get more then from Bloomberg's Rebecca June-Wilkins, who is in Hong Kong and really is ever and always in the weeds when it comes to China's debt crisis, particularly around property and credit. Rebecca, what is happening then with the property sector in China? Get us up to speed.
Well, we've seen the one thing that authorities were really keen to avoid, which is relatively widespread social unrest. Home buyers across 22 different cities in China refusing to pay their mortgage payments, essentially sort of expressing this concern about whether or not their homes are going to be delivered on time. And that was always the real worry, that this could be the fallout of China's sort of very, very strict clampdown on property that started nearly 2 years ago now. And the other concern, of course, here is what pressure that adds to the banks, if that adds NPL pressures, particularly for those kind of local and regional banks that are already under quite a lot of stress with all of those protracted COVID lockdowns too. So we have seen some of that sell-off on bank equities sort of spreading through the day today as well.
What do you say this means for credit markets? And I ask that question because I think in the past what we've seen is the policymakers will step in, offer a little bit of liquidity support and sort of soothe the concerns. Is this time different than in the past, and should we anticipate a broader credit crunch coming?
Absolutely. Well, I think there certainly are signs that a broader crunch is coming, Gina. We've really seen the spread, not just to sort of stronger, healthier developers, but even to other sorts of firms, so industrial firms, non-property firms as well. And if we just take a quick look at some of the investment grade names that have been hit this week, we can look at Vanke, China's second largest developer. It was once considered a strong, really strong investment grade name. That's now 70 cents, 80 cents on the dollar, near record lows for many of the notes there. And just to sort of put this into context, one by one over the past year and a half, we've seen these pillars of strength in China's property market crumble and fall under this liquidity pressure and facing these type of really tight credit crunches. It's been really staggering, and because it's been spread out for so long, it's almost sort of we've gotten so used to it. But I think this concern that no one could be safe from this crackdown has really persisted and spread through the market. And we're also seeing that a lack of liquidity is amplifying a lot of the bond moves. So many players have exited the space because of the record offshore defaults that we've seen. The actual universe of sort of non-defaulted debt is so much smaller than it was just a year ago.
Okay, Bloomberg's Rebecca Chun-Wilkins on Hong Kong on the latest when it comes to that squeeze in terms of debt and the crisis facing the property sector in China. A sector, by the way, by some accounts for about 20% on some measures of Chinese GDP. Coming up, as gas-hungry Europe revives coal plants, complicating its climate ambitions, a blistering heat wave across much of the continent shows just what's at stake. That is today's Big Take. We'll bring you the details. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question. Great question.
Great question.
Great question. That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed. Welcome back to the Open. 52 minutes into the European trading day. Losses of 0.4% across European equities. Futures stateside looking to losses around 0.6% as investors weigh up the prospects of a 1% rate hike from the Federal Reserve at the end of this month. Time now for your Bloomberg Big Take. And Europe is facing an intense summer heat wave. Even here in the UK, record high temperatures have hit parts of the continent, and everyone, even these zoo animals, this is our producer's favourite, are looking for ways to keep cool. Not just people and offices, the animals, as we're seeing here. Also, importantly, arguably more importantly than the elephant, agriculture. Some may take the other side of that view. Heat waves and severe droughts could overwhelm large swathes of Europe this summer, hitting everything from crops to power plants. Joining us now is Bloomberg's EMEA agricultural reporter, Megan Jurison. Megan, good morning. What are some of the examples then of the extreme weather that we're seeing across Europe this year? How bad is it?
Right, so as you mentioned, it has been hot just this week and next. So here in the UK, we're going to be flirting with 35 degrees Celsius. In France, it's closer to 40. So it's been very hot, but these conditions have been with us for much of the year. So Spain and Portugal are facing some of their driest conditions in about a millennium. In Italy, the River Po is near its lowest level in about 70 years. Parts of the riverbed are now visible. In the Rhine River in Western Germany, also seasonally very low. That's a big challenge for industry. So we're seeing, some power plants shut down. And on the agriculture side, crops aren't faring well in this heat. So it just shows the risk of possible further energy or food inflation to come.
Megan, can you dig into that a little bit with us? You hinted that on the agriculture side, there may be some supply disruptions as a result of this heat. Clearly, that's not been in the price, with prices generally plummeting for all of the softs. Tell us a little bit more about that.
Sure. So grain prices have been coming down, but they remain pretty high historically. Prices had surged in the wake of Russia's invasion of Ukraine, and Ukraine is still facing a lot of export challenges for its crops. Here in Europe, given the heat and dryness, the European Commission recently cut its wheat production forecast by about 5 million tons. EU wheat has been, more in demand because of the war, so that's a bit of a challenge for exports. And corn crops now are going to be in the peak of their growing season, so this new wave of heat and dryness gripping Europe is also a challenge. And then for things like fruit and vegetables, Italy has, as I mentioned, has faced quite dry conditions, so that's a challenge there too.
Okay, Megan Jurison, thank you for joining us on the heat wave implications across the agricultural space. Of course, already the challenge around supply chains linked to Ukraine, just exacerbating that. If you'd like to read Megan's piece, and I recommend you do, go to NI Big Take on your terminal. Gina, you've been bumping around Europe, been traveling to various capitals across Europe. You were talking in the break about the oddity of considering and weighing up recession concerns, meeting with your clients who are concerned about these factors, whether it's inflation or recession, but the reality on the ground of being in cities where activity is thriving.
Yeah, it is quite a contrast, because real time, my experience is everything is very active. Every airplane I've been on has been completely booked, if not sold out, looking for people to give away their seats for another flight. Every train I've been on completely booked as well. Restaurants, difficult to get reservations at. It's in the States, it's the very same thing. So you get this sort of real-time feed that activity is very robust, yet the market is clearly anticipating a slowdown. When will that slowdown emerge in the real-time data is a huge question.
And you were talking earlier about divergence as well, and I just wonder whether the risks of focusing squarely on recession are taking us away from some of the stronger and more optimistic pictures that are emerging, particularly within the services part of the economy.
Yeah, and can those growth sort of figures continue to sustain into the second half of the year?
Okay.
Big question.
Gina Martin-Adams, look at her and her team's analysis as well on the terminal, of course, Bloomberg Intelligence Senior Strategist. And just worth highlighting again what's happening in Italy with the political risk there. Italian yields selling off sharply. Italian bonds selling off sharply. Yields up 20 basis points on your 2s and 10s in terms of the Italian BTPs. Plenty more coming up. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
certainly the inflation report suggests that there's no reason to say that a smaller rate increase than we did last time, right? Because nothing moved in that direction.
This report reflects that inflation is unacceptably high.
Right now, they are hyper-focused, solely focused on inflation. And that is their key objective, getting that price stability.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance. This is the Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. U.S. CPI scorches at 9.1%. The Treasury curve inverts to levels not seen since 2000. King dollar pummels euro to parity. Jumbo hike in play. Markets see 50-50 chance of historic 100 basis point move as inflation piles pressure on the Fed. Plus, rebound on the ropes. Draft projections show the EU slashing its GDP forecast amid surging prices and energy crisis. Happy Thursday to you. Everything is in play. Those are the words from Bostic after that red-hot 9-handle CPI reading. That had markets repricing, at least in the bond market, 50-50 odds of 100 basis point move. Also follows Bank of Canada taking the plunge, going jumbo ×2, 100 basis point hike from them, of course. European stocks, those moving lower this morning, down 0.5%. The 2s10s curve, this is where we saw a lot of the pressure come in. That sunk to its most negative level since the dot-com boom and bust. A lot of this has to do with the bid to duration on the long end, looking for the safety, that concern about the economy. There was a 30-year auction yesterday. The leftover of that auction was the lowest on record, really just highlighting the demand that was there. Finally, we have the euro dollar. That did sink to parity yesterday after that CPI reading. A little bit above it now. We have a lot of options around the floor of 1-to-1 that's keeping it from sinking further. Of course, we are looking at volatility. Options pricing 1 week out around the ECB meeting. That volatility is at a 4-month high, so concerns are still clear in this market when it comes to the euro. And finally, looking at BTPs in Italy, those yields up by 21 basis points. There's concern about the government. There's a confidence vote. Conte saying he might boycott that. Draghi saying he'll walk out, he'll resign if that does indeed happen. So that tension means that the spread between Italy and Germany, the yields there, that's blowing out again to the most in a month. Let me show you what European stocks are doing as a whole. That Italy story there, the concern there does mean the FTSE MIB, one of the worst performing. That's down 1.5%, a clear underperformer. DAX, not as bad. UK stocks, those are down 0.4%, but still a lot of repricing and grappling with what it means to have the Fed going all out, with the ECB really curtailed by some of the drama occurring in Italy. Let's continue with that story. Really, our top story today, the U.S. inflation hitting 9.1% in the year to June. That's another fresh 40-year high. It strengthens the Fed's resolve to stay on its aggressive hiking path and makes another jumbo increase in July pretty much certain. The question now, though, will be, does the central bank raise by 75 or 100 basis points?
This inflation print, it's a problem.
This was a very hot report.
There's no slowdown in inflation here.
Domestic price pressures are still quite strong.
This is going to amp up pressure on policymakers.
This keeps pressure on the Fed to keep going.
It needs to keep moving at a rapid clip.
We still think they go 75 in July.
The Fed probably will go 75 basis points.
It's going to be very difficult to get off 75 basis point hikes.
This morning's report seems to solidify that 75 basis points.
But I think they really ought to be careful here, because this is actually turning.
These rate rises are coming as growth is starting to slow.
They can't respond to slowing growth. We know growth is slowing, but I think they're going to just keep going.
And that's a real concern.
Tightening policy into slowing growth is just not a good combo for risk assets.
They can slow down the pace, but I don't think they're anywhere close to stopping.
Let's add another voice to the conversation. We're joined now by Francesco Sandrini, head of multi-asset strategies at Amundi. Francesco, thanks for joining us. So if it is 100 basis points this month, be it stocks, currencies, bonds, which asset is most vulnerable at this point?
But pretty much all the assets are vulnerable at this point. Some of them have already heavily corrected. If you think about commodities, for example, are discounting recession risk, which is probably quite high, with a minus almost 20% from the peak of late May. I think that a lot has been discounted in terms of pricing on the equity market as well. Probably our reading of the situation is that the equities probably are discounting a little less of this chance of recession than the credit markets. And in particular, high yield markets have been ballooning a little more giving the impression to us that there is still a leg to go on the equities, especially considering the flows that so far have been quite muted leaving the equity markets.
That's not too dissimilar from what Marko Kolanovic over at JP Morgan saying that credit, it still perhaps has some pricing to go in terms at least of a recession. BlackRock, though, says that they like credit considering that the risk of default is low at this moment. So, Francesco, would you be selling credit? Would you be buying credit, holding neutral? What do you do with that positioning with that outlook in mind?
Of course, we have still this lack of correspondence between the default rates that normally are lagging and what the price activity have been doing, widening the spreads. At margin, I think that the high yield still contains a little more risk, and we probably see the high yield market widening even more. And this is frankly something that suggests to us to stay quite cautious on the high yield markets. While I think that at the same time, especially on the investment grade corporate bonds, and especially in US more than in Europe, there is a decent constructive approach. And I think that probably these levels are interesting levels to start accumulating a little of this exposure, because the widening has been probably more pronounced in proportion to risk.
Yeah, interesting. You know, perhaps some of the irony of yesterday's CPI was that at the same time we get that published, we get the beige book, and there are more pessimistic mentions in it. This is something the folks over at RBC have worked out. And then we also had this survey from the Chicago Fed, basically saying that economic conditions, expectations for it, 6 to 12 months out are the lowest they've ever been since they started collecting the data in 2013. That's what we're looking at right now. Given these two opposing forces, the deterioration in expectations and the unrelenting nature of inflation, Francesco, what does a hard landing look like?
It depends market by market. I think that on the equities market, we are not so pessimistic because a lot has been already priced in terms of multiple compression because the anticipation of the Fed increase in interest rates. Probably what we have to see at the moment is the depth of the deterioration on the earnings. And the tricky part is the fact that the PPI, the producing prices, is very high in comparison to the CPI, signaling to some extent limited capacities of corporations to shift their pressure on cost on revenues. I think that it's very difficult to call for the equities the bottom at this point, and probably we have still 5, 7, 8% to go. But we are not very far from the level of correction that we have in mind to start reaccumulating.
All right, so perhaps just a bit more pain to go. Francesco, stay put, as Francesco Sandrini, head of multi-asset strategies at Amundi, is going to stick around with us. Now let's get to some of our top stories with the Bloomberg First Word News is Leanne Gerrans. Good morning, Leanne.
Hi, Danny. Bloomberg has learned that China is considering ending a near 2-year ban on Australian coal. The proposal, to be agreed by senior leaders, is prompted by fears that European curbs on Russian energy will increase competition for coal from China's main suppliers like Indonesia. This as Beijing looks to avoid a repeat of last year's power disruptions. The UK's Conservative Party will hold another ballot today in the contest to elect their new leader and Britain's next Prime Minister. The first round of voting saw ex-Chancellor Rishi Sunak and Trade Minister Penny Mordaunt emerge as the front-runners, with a field of 8 candidates now narrowed to just 6. The Fed's Loretta Mester says a hot U.S. inflation print suggests officials should raise rates by at least 75 basis points later this month. The Federal Reserve Bank of Cleveland president spoke exclusively to Bloomberg after U.S. consumer prices rose a faster than forecast 9.1% in the year to June. The Bank of Canada has hiked interest rates by a full percentage point, a surprise move amid fears 4-decade high inflation is now becoming entrenched. In Australia, meanwhile, a hiring boom gathered pace in June, sending the unemployment rate to the lowest in almost 50 years, boosting the case for a supersized rate increase next month. And Sri Lanka's president has missed a deadline for the parliament speaker to submit his resignation. Gotabaya Paksa fled the country for the Maldives as months of inflation-fueled protests did gain momentum. Earlier, protesters stormed the Prime Minister's office, leading authorities to impose a state of emergency. The Prime Minister has restated that Parliament will choose a new president next week. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thank you very much. Coming up on the program, Italy's government is threatened with collapse as coalition tensions spill over. We'll bring you the latest from Rome next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Now, Janet Yellen is in Bali at the G20, speaking at the moment. Some lines there. She says inflation in the U.S. is unacceptably high. This is something that President Biden said yesterday as well. Yellen also saying that Biden administration, that they are supportive of the Fed's steps to control prices. Of course, this all reflects a similar language coming from the president yesterday following CPI. But he also did mention that the backwards-looking figure didn't reflect the 30 days of declines in gasoline. All right, now let's turn our attention to Italy, where the coalition government is at risk of collapse over a dispute on a key aid package vote. For more, we're joined by Bloomberg's Tommaso Ebhart in Milan. Tommaso, walk us through this. So the five-star doesn't have confidence in the current government. Why? What does it center around?
Hi, buongiorno from Milan. So it's a crucial day for Italian politics. The government is really nearing a proper crisis, and Mario Draghi is facing the highest tension in his coalition since he took the job in February 2021. There should be, but you know, we put a question mark here because it hasn't started the vote in the Senate yet. There should be a confidence vote this morning on an aid package. The five-star movement, now the second biggest party in parliament, said it won't vote for Draghi, and Draghi made clear that if he doesn't have the confidence of all his coalition, including the five-star, his government is dead. So it could be a crucial day. Mario Draghi may eventually even go and offer his resignation to the president later today, but as I said at the beginning, it's very much fluid at the moment. We are waiting to see when and if the vote takes place and what's next.
What does this all mean for Italy as a whole, be it the future of political volatility or economic volatility?
So that's a good question, Mark. Reaction today in the market is not, I would say, good for the country. The FTSE MIB, so the stock market is down, is probably the worst performing in Europe. The spread versus the German bond is higher, not massively higher, but anyway, it looks like the cost of Italian debt is going up again. So which is the risk? The risk is again putting Italy in a situation of instability. Since Draghi took the job 1.5 years ago, Italy was a sort of a land of stability in Europe. So we may go back to the old good or bad Italy political chaos.
Tommaso, grazie mille. Tommaso Ebhardt there from Milan. And staying in Milan, let's get over to Francesco Sandrini, head of multi-asset strategies at Amundi. Francesco, that's all I got in my Italian repertoire, so I won't try any more with you. But okay, Tommaso there talking about the political risk. We're looking at BTP's spreads wider on the 10-year by about 22 basis points. Game out for me the market impact of political volatility in Italy.
No, of course, there is an impact, and as Tommaso was correctly saying, is an impact that is still quite limited because still we do not have visibility. We have to understand where we are from the macroeconomic point of view because we are still in a framework in which, albeit deteriorating, we are still forecasting a decent growth for 2022, 2.3%, and 2023. And this is very much affected by deteriorating consumption, but what it is very solid is still the capex, so the investments from corporations that are to some extent taking some benefit from the next-gen plan by the European Commission. So I think that this is very much what it is at stake with this crisis. It's hard to see at the moment what is going to happen, but would be a pity to derail this kind of positive upward trend of the Italian economy. In terms of BTP spreads implication, very quickly, until when the market will not be pricing a new political force discussing openly about an Italy exit as it happened in the past, so an exit from Italy from the European Union, I think that the pressures on the BTP will stay to some extent contained.
Okay, does that mean you're not generally worried about a form of a debt crisis or some other as we get the ECB hiking rates?
Let's say that I'm not yet, in the sense that I was expecting this to happen in any case in November, approaching the last 6 months of the Draghi administration. So I think it is very important to acknowledge that it's no one's interest at the moment to create or to run a political campaign threatening to leave the euro as it happened in the past because of the massive fiscal plan that was deployed, and this is actually something extremely positive for the growth perspectives of Italy. So until when this will not put at risk, I'm still relatively concerned and relaxed, but I think this is not the trigger yet for a massive blowing out of the debts.
Okay, so concerned, but perhaps not drastically so. I do wonder, though, as we get these political pressures, we look for different governments to give aid, be it to corporations, be it cutting taxes. I look here in the UK, that's certainly on the platform of a lot of those running to lead the Conservative Party. Francesco, is there a risk that the politics is something that continues to fuel inflation because of that pressure of a population that faces a cost of living challenge?
Absolutely. This is the name of the threat. Without any doubts, I'm totally with you. I think that the pressures on rising inflation are eroding to some extent the capacity of spending of the weaker cohorts of the population. So naturally, this is the perfect environment for populist parties to come back. And I think this is something that we start already seeing in France, this line of political instability that will probably spread to Italy moving forward. And this is the major risk that the European institutions have to face moving forward with a proper fiscal package in the future.
Francesco, thanks so much for joining us this morning. Francesco Santrini, head of multi-asset strategies at Amundi. Coming up, a commercial break for Netflix. The streamer picks Microsoft as its partner for a new advertising-supported service after years of saying it wouldn't do ads. We're going to bring you the details next. This is Bloomberg.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. We're looking at pictures of Yellen in Bali. She's there for the G20. She has said that inflation is in the U.S. is unacceptably high. This is something she also, Biden also said yesterday as well, but talked about the backward-looking nature of CPI, didn't reflect the downdraft in gasoline prices. Yellen also saying now that no decision yet on Russia oil price cap level, but has been speaking about it, saying it would help to lower inflation in the U.S. Like a price plan would be worse for Russia, she says currently. She also is talking about China, saying that China should work to restructure Sri Lanka debt. Of course, we've seen that tension in Sri Lanka. Yellen just stepping off the stage there, but also talking about China, saying that she wants the G20 to put more pressure on China over debt. So Yellen there just wrapping up her speech at the G20. Now on to other U.S. matters. Netflix has selected Microsoft as a partner for its service with advertisements, which the streaming giant hopes will be running by the end of the year. Bloomberg's Laura Wright has been digging across the details. So Laura, what would this look like?
Well, Netflix fractionally lower in pre-market trading. And Dana, we first learned of the platform's intention to launch such a service last quarter. And interestingly, the average revenue per user would actually be higher on an ad-supported service, which is cheaper compared to the standard offering. Now, Microsoft was able to outmaneuver advertising heavyweights such as Alphabet and Comcast to clinch the deal. The COO of Netflix praised Microsoft's privacy protections. Netflix views privacy as imperative for its customers. Also, Microsoft is not seen as a direct competitor to Netflix, whereas Alphabet and Comcast both have their own video offerings such as YouTube, NBC, as well another platform which escapes me right now.
Yeah, Laura, and of course we also have Netflix earnings coming next week. I believe it's the 19th. You can correct me if I'm wrong. But ahead of that, what are the headwinds that Netflix might be facing?
Yeah, well, Netflix has experienced some heavy losses already year to date, down almost 71%. Economic reopening, central bank tightening, consumers' incomes under pressure. And there are serious questions about the heavy content spend, forecast to be $18 billion in 2022 alone, to try and offset growing competition. But investors want to see returns now. Also, what is Netflix going to do about the additional 100 million households that piggyback off existing users' accounts?
Who Laura Wright may or may not be part of, me as well. We'll keep that a secret between us. Laura, thanks so much. Bloomberg's Laura Wright. Coming up, travel turmoil from London to Berlin, chaotic scenes playing out across Europe's airport. We're going to be joined by the CEO of Trip Abroad, Alexa Rathbone-Baker, to discuss. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
U.S. CPI scorches at 9.1% as the Treasury curve inverts levels not seen since 2000. King dollar pummels the euro to parity. Jumbo hike in play. Markets see a 50-50 chance of a historic 100 basis point move, with inflation piling pressure on the Fed. Plus, rebound on the ropes. Draft projections show the EU slashing its GDP forecast with surging prices and an energy crisis. Good morning, happy Thursday, and welcome to Bloomberg Surveillance, the early edition. I'm Danny Berger in London, in for Francine Lacqua. Negative markets this morning, not much risk appetite, but not too drastic of moves, especially in equity markets. We're down 0.5%. U.S. futures down about the same amount, which is remarkable considering we just got this hot CPI reading yesterday that's fueling bets for a 100 basis point rise from the Fed next week. You think equities might be doing worse, but perhaps it's this idea that much of the recession is already priced in. We were talking to our guest, Francesco, earlier about that from Amundi, who said only a little bit further to go perhaps to price all this in. It could also be what we're seeing in the yield curve. Yes, you might think this is negative, bad economy, bad for stocks. It's at its most inverted since 2000. However, this bid for duration is because of the concerns about the economy. 30-year yields, that auction yesterday, very, very strong. That might indicate that duration is an okay place to be, and things like tech might be all right in the coming environment, especially if the Fed is going to start cutting rates in 2023. Check on the euro there. That is just above parity. It hit parity levels yesterday after the CPI report. And finally, the last thing you see there, that's BTP's Italian yields, your 10-year yield. Those are up by 22 basis points. There's concern around the Italian government, whether a coalition is falling apart. Rather, that means the spread between Italy and Germany, 10-year yields now at the widest in about a month. Now, our other top story today is the travel chaos. And travelers in Europe, they're paying ever more for a plane ticket, and yet somehow have less of a chance of actually making it to their destination. Now, Asia's travel industry, that's still navigating COVID-19. The U.S., for their part, it's a shortage of pilots. Ticket pricing and cancellation data show that Europe is where the turmoil is inflicting maximum pain on customers. We're joined now by Alexa Maria Rathbone-Barker, CEO and co-founder of Trip Abroad. It's an AI-based family holiday booking platform. And Alexa, if there's one group of travelers who perhaps are used to chaos and want to limit as much chaos as possible, it's those traveling with children and traveling with families. The sort of behavior you've seen on your platform, booking trips, have you seen any change in behavior or appetite with rising prices and concerns about what the trip to the airport will look like?
Yeah, well, firstly, thank you very much, Danny, for having me on the show. It's a real privilege to be here. So as you said, when you're thinking around going on holiday with your children, obviously it is quite concerning looking at the news stories and the reality of what's happening in the airports. However, I suppose what we're finding is that after so long not traveling, the desire to go away, certainly for families who have nearly finished the end of term or even finished in some cases, is very high. So the family segment was the fastest to rebound out of COVID and currently is tracking at around 80% of what the levels were of bookings pre-pandemic in 2019. So the demand is still very strong despite all of the challenges that consumers are facing.
Is there a level you see, Alexa, where there will be demand destruction, that prices get so prohibitively expensive, or do you think the families are just saved up enough and they'll continue to be willing to pay up?
Yeah, I think families are very savvy around what they're spending their money on. And, when you think around the experiences that their children have missed out on after so many years, really where they want to place their value is on making memories as a family. And this summer is really a kind of pivotal point to starting to explore the world again. What we are seeing certainly on our platform is that from a basket size perspective, we're trending well above 10x what the industry typically books on accommodation, and we're accommodation only platform. And so what that is showing is strong demand from consumers, but really a desire not to compromise on the things that they can control. So while there are challenges with how do you get to your destination, what parents and consumers can really focus on is making sure that they find the right place to stay and the right destination for their needs.
Alexa, what is the environment for funding right now as a tech-enabled travel company? Is there still demand and interest from investors?
Yeah, it's a great question, because I think, certainly when you look at some of the most successful businesses in the world, when you talk about tech startups, most of them were founded in a recession. And, when you look at the travel industry and you look at the demand, I think the current situation in airports is only a strong reflection of consumer appetite to travel. And when you look at the areas that consumers are spending the most on coming out of the pandemic, it is travel and it's food. And so when you look at those sectors that want to go long on from an investment perspective and future value, I think it's a fantastic opportunity for investors to explore the travel sector. There are some amazing companies that are doing some really innovative things, and consumers are ready for a shift. And I think that's certainly what we've seen from a technology perspective, a tech-focused perspective in travel. Consumers have become more tech savvy, certainly our customers in terms of parents, and the expectations on the level of customer service in particular is much higher than it's ever been.
Well, what does competition look like, Alexa? Because you talk about the need, a lot of people want this type of service. Is there a lot of competition in the space?
Yes, so in terms of family travel, we're actually the world's first AI-powered family travel booking experience. And what we've done is we've said families are different to your typical traveler. They have different needs, they're more complex. And for too long, really, families have been squished into that sort of typical traveler model. And anyone who's traveled with kids knows that it's a completely different ballgame when you have kids and you travel versus when you don't. And so, we are really carving out that niche and that segment for parents and thinking about how do we build technology that thinks and acts like a parent thinks and acts when they're researching and booking their holiday. How we hold their hand through the journey all the way from booking to when they return from travel.
All right. Alexa, thanks so much for joining us. That's Alexa Maria Rathbone-Barker, CEO and co-founder of Trip Abroad. Turning to equities now, at the lows of the session, S&P 500 futures, those are down just less than 1%. We are looking at Russell 2000 futures. Those are down more than 1%. It really shows the economic angst that's playing through these markets. Stocks remarkably resilient yesterday in the face of a red-hot CPI. Will that last, though? We have University of Michigan data that's due out tomorrow. The Fed in the past has made these jumbo hikes move to 75 because of not just the CPI, but combined with UMich. So that could be another potential risk event for these markets. Perhaps we hang tight until then. Of course, we do see the bond market continuing to be under pressure, yield curve at its most inverted since 2000. Coming up, a gas-hungry Europe revives coal plants, complicating its climate ambitions, and a blistering heat wave across much of the continent shows just what's at stake. That says Dutch nat gas futures. Little change today. We'll get into the big take. This is Bloomberg.
crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Well, after yesterday's CPI, it's all about King Dollar and the yen being impacted by it for a second day. Currently, the yen is at 139.24 at a fresh new high, of course, the highest since 1998. Will it reach 140 as the Fed is forced to put their foot on the pedal? Will it be 100 basis points? As that gets priced into the market, we continue to see the pain in the yen with yield curve control. The BOJ so far not letting go of that. Now, turning to Europe, a gas-hungry Europe reviving coal plants, complicating its climate ambitions, the blistering heat, all of that together in this summer shows what's at stake. That's today's Big Take, a little bit of rhyming for you there. NI Big Take Go is where you find it on your terminal. But for more, let's get to one of our authors of the piece. It's Bloomberg's John Anger. So, John, what's happening across Europe right now? To break down those forces for us and what the implications of them are.
Hi, Danny. Well, yes, as you're probably well aware, sitting there in London, we are being hit by a big heat wave at the moment in Brussels too, and across the rest of Europe, and that's having some quite damaging effects. Most notably, rivers are being dried up. That has a number of impacts from generating power, possibly closing nuclear power stations. Water is needed for the steam to generate electricity, but there's also other impacts. So you could start to see food prices rise even more as crops die and wilt. We spoke to one person in our article today who's having to harvest their crops during the night for fear that sparks generated from hot tractors could set off fires. So this is really adding to what is already a very complex picture in Europe with regard to the economy, to inflation, and also just to the bloc's climate ambitions, which it's important to know are incredibly important to keep on track at the moment.
Yeah, John, dig more into that. What does it mean for those ambitious climate plans?
Yes, so we know last year, before everything kicked off between Russia and Ukraine, that the European Commission and the EU more broadly enshrined into law a commitment to reach climate neutrality by 2050. And as part of that, they unveiled a raft of new legislation, from phasing out the combustion engine in cars to reforming the bloc's carbon markets, to energy efficiency, to boosting renewables. Now, all of these are kind of still on track. Over the last month, both EU Parliament and member states have made progress and have come to their own conclusions on the positions. But we know as well that in the short term, as you mentioned in your opening segment, that coal plants are being restarted. And now that means that over the next couple of years at least, emissions are quite likely to rise. And so for the EU to meet its climate ambitions, it's going to have to act faster later in the decade to make sure that the 2030 goals stay on track.
So how is the bloc then, John, trying to balance ridding itself of Russian fossil fuels, again, given the environment that you're describing?
Well, right now, that's one of the biggest headaches that political leaders in Brussels have. So yes, as you said, on the one side, it really needs to get rid of that Russian dependency. Before the war, the EU imported around 40% of its gas from Russia. It wants to bring that down to 0% in the next few years. But at the same time, it wants to keep its climate ambitions on track. So in the short term, what the EU is trying to do is secure alternative supplies of gas, liquefied natural gas in particular, from countries like Qatar, from Azerbaijan, from the US. But in the longer term, it really wants to see an acceleration of renewable energy. And that could mean faster permitting for wind farms, for example, or it could mean that when we build new houses in the EU, that those might have to have solar panels on the top in order to really pivot to this net zero economy that the EU wants to have.
John, thanks so much, and great work on the big take today. That's Bloomberg's John Anger. And if you'd like to read the piece on the big take, again, NI Big Take is where you want to head to on your terminal. Now let's get to your Bloomberg Business Flash. With that is Leanne Gerrans. Hi, Leanne.
Hi, Danny. TSMC has reported better than expected earnings. The latest signal that electronics demand is holding up better than feared. The results from Apple's most important chip maker may allay fears about an economic slowdown and soaring inflation. The euro has crossed a major threshold, dropping to parity with the dollar for the first time in 2 decades. The single currency's 12% decline this year comes as Europe's energy crisis and recession risks weigh on sentiment, and risks fueling a further spike in inflation for consumers. And Netflix has chosen Microsoft as the tech and sales partner for its new advert-supported streaming service. Now that's set to launch in the fourth quarter. The absence of ads has long been a selling point for Netflix, but slowing growth has forced a streaming giant to look for new ways to grow their revenue. And that's your Bloomberg Business Flash. Danny.
Leanne, thanks so much. Another banking earnings season, it has arrived. JP Morgan will step up to the plate first, offering investors a sense of how lenders have fared over the past quarter amid the slowing economy. Now, expectations for the sector, they are mixed. Analysts focus on the bank loans loss provisions, reflecting their assessment of recession risk. That will be really what we laser in on. For more, we're joined by Bloomberg U.S. finance team leader Michael Moore. All right, Michael, so we have a few reporting today. What are we expecting?
You know, I think we're expecting a sharp divergence in the two Wall Street businesses. Trading doing quite well, seizing on the market volatility as investors have repositioned. That's created a lot of activity for the trading desks. So that's expected to be a boon. But investment banking, on the other hand, has slowed significantly, both on the deal side. You know, IPOs have largely disappeared. Even debt issuance is down. So I think you're going to see some dramatic changes in those businesses from a revenue perspective. And then there's going to be the benefit from higher rates. We'll see that come through with the net interest income. It's expected to be up significantly for most of the banks. And that will probably continue this year as the Fed continues to hike.
Right.
But as you noted, you know, the big question is what happens to the economy?
Yes.
How bad does it get? You know, are we going to see a divergence of opinion from these executives?
Yeah, are we in a hurricane?
Yes, yes. As Jamie
to
says,
that point, I mean, will any of that stress you think show up in lending operations this quarter, or is it more going to be looking ahead?
I think because the credit provisions have to be, by definition, forward-looking, I think you will start to see it show up. And whether we see banks, you know, have different approaches to that, of, you know, different expectations of how bad it's going to get, that may show up not just in their commentary, but in the level of provisioning they do. And, you know, as Jamie has raised the question of the hurricane, is it a Category 1 or a Category 5?
Has he named it yet?
Yeah,
you know,
exactly.
all of the important questions.
Yes.
In terms of dispersion among the banks, any differences we might see? What should we look out for there?
I think you'll see that in the credit provisioning, but also, you know, the business mix. You know, the higher rates is certainly going to benefit the Wells Fargo's and the Bank of America's, the large retail operations. But within the Wall Street side of things, you know, who seized on this trading environment? We saw that in the first quarter where, you know, it was an active market, people did well, but there was definitely gradations of how people did. You know, you saw even in Europe, Deutsche Bank did quite well, Credit Suisse struggled. So do we see any of those divergence?
Okay, Michael, thank you very much. That's Michael Moore from our finance team, giving us a preview again. JP Morgan, Morgan Stanley due to hit later today. We are looking at risk sentiment more generally falling apart as we get closer to the U.S. Open. We're looking at oil now declining pretty forcefully. Brent, that's down 1.8%, but WTI crude down 2%. A lot of fears here in terms of demand destruction, high prices, an economy that's on the back foot as we see inflation hit 9.1%. Of course, the backdrop for oil is also President Biden, who's in the Middle East right now due to travel to Saudi. There might be conversation there about releasing more oil, producing more oil, but still, that's not what it's about right now. It's about those macro forces in a still very tight market. Also looking at the energy sector, that's falling some 2%. In general, I should say, stocks are falling. We're at the lows of the session for U.S. futures, down 1.2%. What's performing the worst? It is tech and it is small caps. So two forces going on there. If small caps are underperforming, it would stand to reason it's the same force of oil, of that economic concern for those sensitive stocks to the economy. But if tech is also selling off, NASDAQ futures, those are down 1.2%. It's those fears of a rate hike. The NASDAQ actually outperformed yesterday, perhaps because there was that bid into duration. There still is a slight bit of that today. We're mostly seeing bonds selling off so far this morning, but it's that yield curve. It continues to get more steep, to get more negative, I should say, steep, but in the opposite direction. Currently, your 2s, 10s, that is at a negative 23.5. That is its most inverted since 2000. Coming up, we're going to continue that conversation. Inflation, it's remaining stubborn. Recession risk, they have risen. It's being reflected in the market today that is selling off. And then there's a warning from Loretta Mester. We're going to all of that with our exclusive interview with the Cleveland Fed president next. This is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
And it was uniformly bad. There was no good news in that report at all. Was that inflation remains at an unacceptably high level. We at the Fed have to be very deliberate and intentional about continuing on this path of raising our interest rate until we get and see convincing evidence that inflation is turned the corner, is on a downward path, and is sustainably on a downward path.
and that we just have more work to do.
If we had asked you about 100 basis points a couple of weeks ago, 2 or 3 months ago, I don't even think we'd have thought to ask you. Is that something, though, you could see being discussed? Would you discuss it? Is it something, given what we see in inflation now, that is, quote unquote, on the table, that maybe has to be under consideration because the Fed has to figure out just how aggressive you have to be?
Well, we're going to have the meeting and we're going to talk about what the appropriate path of policy is. And again, you know, we don't have to make a decision today. We're going to take into account all the data. But, you know, we're having this conversation. The markets are having a conversation and putting their money where their mouth is in terms of where market expectations are. So we're going to be talking about the appropriate path of policy. And I have not seen any convincing evidence that inflation has turned the corner. Certainly, the inflation report suggests that there's no reason to say that a smaller rate increase than we did last time, right? Because nothing moved in that direction.
Cleveland Fed President Loretta Mester there on that 9.1% inflation reading for June. And that impact of that inflation reading, the fear of how far the Fed is going to go, will it be 100 basis points, and what that means for the economy, those effects rippling throughout markets, I would say even more intense this morning than it was yesterday. The GMM, it is all red, save for King Dollar. That is up 0.6% for your Bloomberg dollar spot. A couple interesting things here to highlight. You'll look at the top of equity markets for the worst selling off in sovereign bonds. It's Italy. And it is Italy. FTSE MIB down 2.2%. It's not just the fear of widening spreads as you get the ECB needing to act as well. It's also political drama in Italy of fear over a coalition government that might fall apart. So in foreign exchange, you see yen, a fresh high there. That is trading at 139, its highest since 1998. In commodities, all red. It is the fear of growth. Iron ore, that is down 6.8%. Crude, that is also down 2%. Bloomberg Surveillance Early Edition, it'll continue in the next hour with those market moves. Matt Miller and Kaylee Lyons in New York and Anna Edwards in London. This is Bloomberg.
the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
It all comes back to this inflation story.
Every developed market is facing the same problems in terms of high inflation, slowing growth, declining real wages.
This report reflects that inflation is unacceptably high. Our economy looks well positioned to deal with the challenges faced by the Fed.
This is going to amp up pressure on policymakers, both in the White House and monetary policymakers, to make a stronger move to provide near-term relief.
We don't have to make a decision today. We're going to take into account all the data.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It is 5 a.m. in New York, 10 a.m. in London, 5 p.m. in Hong Kong. Welcome to Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lines. Anna Edwards is with us out of London. Our top stories today: the Fed could be on the verge of an historic rate hike. The latest inflation report may push the central bank to consider a full 1% increase this month. Meanwhile, Wall Street traders are raking it in. The biggest U.S. banks are expected to report a double-digit increase in trading revenue. J.P. Morgan and Morgan Stanley kick off earnings season today. And Biden in the Middle East, day 2. He'll commit to extending a military agreement with Israel and prepare for that crucial meeting with the Saudi Crown Prince on Friday. So a lot going on this Thursday morning. Let's get a look at how the markets are doing, starting with Kaylee Lines here on what's happening in Asia. Kaylee?
Well, it was a mixed day in Asia overnight, Matt. On the one hand, you had Japanese equities higher, but in Hong Kong, they were lower, for example. So you put it all together, and the MSCI Asia Pacific Index was actually down by about 0.5%. The market, of course, really focused on that hot inflation and the aggressive, supersized moves that central banks are making. New Zealand, of course, was one of them yesterday, the third half-point hike in a row. And as a result, the two-year yield up 16 basis points overnight to around 3.52%. Now, of course, while other central banks are hiking, the Bank of Japan is absolutely not. They are keeping policy easy, and especially as there's now a conversation about the Fed potentially moving 100 basis points this month, that rate differential story just becomes more and more exacerbated. So that is dragging on the Japanese yen. It is at a fresh 24-year low against the U.S. dollar. Right now at 139, that is the weakest level since August of 1998. And finally, given all the concern out there that the central banks are going to go too hard, that they're going to lead to an economic slowdown or potentially a recession, that is weighing on commodities, given the demand fear out there, including iron ore down 7%, now at its lowest level since December, trading just above $101, Anna.
Kaylee, let's have a look at the European equity market picture. And things are worsening, actually, as we go through today's session. You can see the map looks pretty uniformly red, in particular in Italy. But we are seeing some negativity across European equity markets today. And really, it is that same picture hangs over global markets. Just how much tightening are we going to see from the Fed, and how much tightening do we see from global central banks? Also, very much part of the conversation. We're just getting some news out of the euro area. Revisions to their forecast, their estimates for where GDP and inflation goes in the Eurozone. And we had a draft copy of this earlier on. So this not necessarily new information, but confirming what we already knew essentially from the euro area. So GDP to grow by 2.6% in 2022, 1.4% in 2023. So they're downgrading their growth expectations for the euro area. They are upgrading their inflation expectations. Inflation for 22 seen at 7.6%, then 4% next year. So even that not back down to target during next year. So that's the data picture, that worsening data picture across Europe. Let's have a look in more detail at what we see on European markets today. Then I showed you the sea of red that we had on the European map there. Well, a lot of that coming, or some of that coming from Italy. And there's a lot of politics to talk about in Italy today. And we'll do that in just a moment. We'll get an update on what's going on from our colleagues in Rome. But the Italian stock market down by just over 2%. A lot of nervousness as to whether Mario Draghi will still be prime minister by the end of today. And we should learn more about that in the next couple of hours or so. Bank stocks very much to the fore when it comes to that falling stock market story over in Italy. Also, that same story having an impact on bond markets. It's sending yields higher on BTPs, that's Italian government debt. It's also widening spreads between BTPs and German debt. I put in the euro dollar as well here, Matt, because we spent quite a lot of time on parity watch and blinked and you missed it. We did go down below parity for the euro against the US dollar, so a number below 1, but we've climbed back up above that only just. We're at 1.0027. You need at least 3 decimal places to catch that.
What do you see on U.S. markets, Matt?
Yeah, we see S&P futures down more than 1% right now, and they're declining. So I had to do a double check here because when I looked just a few minutes ago, they were down 0.8%. So continues to worsen here. And remember last time we got that big inflation print on June 10th, we saw a drop of 2% on day one and then 4% on the next trading session. So maybe today will be worse as investors digest this and also get producer price index, which is so important, of course, to earnings margins. The 10-year yield right now up about 4 basis points at 297.43, but still holding below 3%. So still maybe a little bit of a support to the S&P, although as you can see, futures continue to move lower and lower. NYMEX crude also continues to move lower, down $2.70, $93.56. Almost seems cheap right now. So not only below 100, but $7 down. And Bitcoin right now about 0.5%, but still holding at that $20,000 level. So 19,765. The interesting thing here is that yesterday's 9.1% CPI print didn't destroy Bitcoin. Remember last time we had a big CPI print, Bitcoin went down another $10,000 in a few trading sessions. And so far, we haven't seen that yet, Kaylee.
Yep, still in that range. The question is, how long does that last? So aside from being on Bitcoin Watch, let's take a look at what else is ahead today. The UK Conservative Party will be holding another ballot in the contest to elect a new leader and new prime minister. At least one of the 6 remaining contenders will be knocked out after Tory MPs vote. Then we'll get second quarter earnings from Wall Street banks. It's kicking off with JP Morgan and Morgan Stanley later this morning. Then, as Matt mentioned, 8:30 a.m. New York time, we will get that crucial U.S. PPI data. Does it too come in hot? And we'll get live reaction from officials on the Federal Reserve at 11:30 a.m. Eastern. Fed Governor Christopher Waller will be participating in a Q&A moderated by Bloomberg Television's Michael McKee. Matt.
All right, so we're paying very close attention to the Fed, obviously. And the Fed may debate an historic 1 percentage point rate hike later this month. That's after another searing inflation report piled pressure on the central bank to act. We haven't seen moves that big since Paul Volcker. Atlanta Fed President Raphael Bostic told reporters yesterday that everything is in play, and then he repeated, he means everything. Cleveland Fed President Loretta Mester told us exclusively that she supports at least 75 basis points in July.
Certainly, the inflation report suggests that there's no reason to say that a smaller rate increase than we did last time, right? Because nothing moved in that direction.
Bloomberg Markets correspondent Kriti Gupta joins us now to talk about what we can expect. So at least 75, right?
At least 75. At least that seems like that's the consensus from the Federal Reserve. But remember, Nomura actually came out ahead of it and said, well, the market's pricing in 100. We think it's going to go to 100. There's always the questions about the psychological level and effect that has on the actual American consumer. Is the Fed actually concerned about just perhaps how aggressive they should be if they're hitting that 100 level? That's going to be something that comes up. But let's talk about the market moves here, because you mentioned this is the biggest inflation move since Paul Volcker's time. Well, let's put this into perspective for the markets, because the 2s-10s curve is inverting. Consensus is that, and we're looking at a chart of it right now for a radio audience, stick with me. The 2s-10s curve is really important as a recession indicator. The consensus here is that it has to stay inverted for at least 2 to 3 weeks to really foresee a recession. It is now down negative 23 basis points. But if you go back in history, it tends to drop about 40 or 50 basis points before recessions. If you go back to Volcker's time, it dropped over 200 basis points, so negative 200. We are a far cry from that. But it really does put that into perspective. Even though you're seeing inflation extremely high and really paralleling what you're seeing 40 years ago, that's not necessarily the case in the markets at the moment.
Kriti, thanks very much. Bloomberg's Kriti Gupta with the latest on the Fed and the Fed's market reaction. And Kaylee, thinking about what we saw from the Fed, or what we saw from inflation data rather, and what that means for the Fed, and thinking about where we go now on the earnings story, of course, the banking sector, one sector that'll be front and foremost in the days ahead, and one sector that should benefit from increasing interest rates, but recession fears could hang over the sector as well.
Yeah, that's really the catch-22, Anna, because on the one hand, rates are higher. In theory, that helps with net interest income. Also, given all of the volatility that is out there, it can help on trading too. But in the face of higher rates, what's happening to loan growth, especially mortgages, and the kind of commentary we may get around the health of the consumer and the prospects of a recession is definitely something we're going to be paying very close attention to on the earnings calls. So let's get more on this now, as another bank earnings season is just a couple hours away. Bloomberg's finance and Wall Street correspondent Sonali Basak is with us now. So Sonali, JP Morgan kicks us off. We'll get Morgan Stanley later this morning. morning. What are the primary things you are watching for?
Yeah, trading is obviously expected to rise, and JP Morgan would be a big beneficiary of that, given the volatility in rates trading and commodities. They are the gorilla in the room when you look at those businesses. And Morgan Stanley, remember, equities volatility was up, but the equities business with such little issuance was so pressured. With that said, JP Morgan and Morgan Stanley are trading more richly than almost any of the other banks. You have to wonder how much more these banks have to fall when you have Goldman Sachs, Wells Fargo, and Citigroup all trading just below book value. So they've sold off quite a bit, but again, trading gains are very volatile. Can it get any better than this?
We're going to be watching also very closely loan growth. Net interest margins are interesting right now because we're in a rising rate environment, but we have an inverted yield curve.
Yeah, and that's certainly true, and you have to wonder if JP Morgan will start to announce provisions for loan losses again with the deteriorating economic condition. You know, Jamie Dimon doesn't love to play Jay Powell, but he will get asked a lot about the meaning of a 100-point rate hike for him. How much more will that contribute to net interest income? And this inverted yield curve, at the end of the day, they did give very specific guidance earlier on what an inverted yield curve and a flatter yield curve would mean on net interest margins in the future. How much worse can it get?
Yeah, I'm really looking forward to today's hurricane forecast from Jamie Dimon. Bloomberg Sonali Basak, thank you so much. Now let's turn to the Middle East. President Biden is expected to announce his commitment to extending an agreement that provides billions of dollars for the Israeli military. The president is in Israel and has been meeting with the prime minister there. Anne-Marie Horder, Bloomberg Washington correspondent, joins us now from Jerusalem for the latest. Anne-Marie, what's the latest from the ground?
What we do know is that there's going to be this expansion of this declaration, that they agree that they want to expand it. Right now, the current deal with billions of dollars for Israeli defense goes through 2028. We don't have an end date on where the Biden administration could see that expansion last, but it just shows the commitment and that steadfast relationship you have between Washington and Israel when it comes to their defense. This is critically important for Israel, especially as they view Iran in the region as a massive threat. We should note, though, it wasn't without its fraught negotiations in the past when the Obama administration was dealing with former Prime Minister Benjamin Netanyahu, who President Biden will also meet today. He's now the opposition leader. There was a lot of disagreements when they were hammering out this defense deal because the Obama administration was trying to do this nuclear deal with Iran. So there have been hurdles in the past, but really it's just a deliverable that you can almost expect every time a U.S. president comes to Israel.
And there was also a lot of camaraderie with the Israelis, a lot of handshaking, almost hugs, right? What do we expect tomorrow when the president meets with Crown Prince Mohammed bin Salman in Saudi Arabia?
It's a great question because this is going to be incredibly important, not just in terms of what the deliverables are in the kingdom with the United States, but just the human interaction between these two people. Mohammed bin Salman, the president, Joe Biden, when he was campaigning, vowed to make a pariah. The White House going into this trip said they were limiting handshakes. They didn't want to have handshakes due to COVID precautions. But nearly 20 minutes outside Air Force One, you see the president shaking lots of hands. So there is this expectation that potentially he's going to have to shake Mohammed bin Salman's hand. And this is a president who released that intel report that said that this individual approved the killing of Jamal Khashoggi.
Anne-Marie, thanks very much. Bloomberg's Anne-Marie Horder with an update for us on that trip from Jerusalem. Now, here in the UK, another round of Conservative Party balloting is set for to take place. That will determine the next Prime Minister, of course. The field of candidates has now been cut to 6. Former Chancellor Rishi Sunak and Trade Minister Penny Mordaunt have emerged as the two front runners at this stage. At least one member of the field will be knocked out after today's vote. Elsewhere, there's political turmoil in other parts of Europe, namely in Italy. Italy's five-star movement will refuse to back Mario Draghi's government in a confidence vote today, raising the prospect that the Prime Minister might have to offer his resignation. Let's get more from Alessandra Speciali, our Rome Bureau Chief. Alessandra, very nice to have you with us. So this might see Prime Minister Mario Draghi going to see the President and offering his resignation, but I understand that might not be accepted. Give us a sense of how this might play out.
This is very complicated. Italy is sort of turning itself into one of its usually very complex, very convoluted crises. So we expect there to be a confidence vote today in Rome. This is not even 100% certain, as they are trying to find alternatives. And if Conte and his five-star movement sit out, then Draghi will go to President Mattarella and hand in his resignation. And after that, it's in Mattarella's hands to try and find a compromise and avoid early elections, avoid a government crisis in the middle of an energy crunch and of Russia's war against Ukraine.
All right, well, we'll have to see how this one plays out. Bloomberg's Alessandro Speciale, thank you so much joining us from Italy. Now let's get back to the U.S. and take a look at some stocks moving in pre-market trading here in the States. I have to begin with Tesla, which is lower in early hours, and there's a few things going on here. On the one hand, you had news overnight that its top AI and autopilot executive was leaving the company. Then this morning, Adam Jonas over at Morgan Stanley cutting his price target on the stock as well as on GM and a number of other companies, citing economic headwinds. That price target from Adam Jonas now stands at $11.50. It's trading at $7.03 this morning, down about 1%. You also have some stocks moving lower, even though we've gotten some maybe positive news. That would be Netflix introducing commercial or advertising revenue service by the fourth quarter. They have selected Microsoft as their partner in that effort. Of course, as subscriber growth wanes, they're trying to figure out other methods of monetization. But Microsoft is down about 0.9%. Netflix down by about 1% as well. And finally, one more analyst-related mover to talk about. That would be Cisco, downgraded at JP Morgan, $51 price target on the stock. It's trading just south of $42 a share this morning, down about 2% before the bell, Anna.
Kaylee, coming up on this program, we will get to the economics with Anna Titareva, UBS European economist. What does she make of the aftermath of that CPI data out of the United States? What does it mean for Europe and the pace of rate hikes here in Europe? We'll also talk about the European Commission cutting its GDP forecast and upping inflation guidance. On that note, don't miss our interview with the EU Economy Commissioner Paolo Gentiloni. That is at 11 a.m. New York time, 4 p.m. here in London. Plus, the dangers of weakening climate goals. Today's Big Take story shows what's at stake as Europe turns back towards coal power in the blistering summer heat. Look for that on Bloomberg.com or by typing NI Big Take into your Bloomberg terminal. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
earnings season is here.
It's a low bar going into earnings season. There are bargains out there to be had.
Bloomberg is fastest with the numbers and analysis.
There's conflicting and complex cross currents. Strap yourself in for this earnings season.
Bloomberg, the fastest numbers and analysis you trust.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on both Bloomberg Radio and Bloomberg Television. We got a pretty shocking inflation printout yesterday. CPI up 9.1% year over year, and we're going to get PPI out a little bit later. PPI has actually been produced, the producer price index, rising at an even faster pace than the consumer price index. And that's a concern for company margins as we start earnings season. Joining us now is Justina Lee, Bloomberg Markets reporter, to talk about, Justina, how is this inflation, this accelerated inflation, affecting market assets?
Yeah, I mean, those CPI prints yesterday were pretty worrying. We saw inflationary pressures broadening kind of beyond, just the goods category. And we kind of got a pretty interesting response in bonds, which was that, the front end yield surge, the kind of the longer end, from 10-year onward, didn't move as much, and which was why we had the yield curve invert. And what that really shows is that people are quite convinced that the Fed won't be able to avoid a recession in this process of tightening its policy, to the extent where we're actually starting to see markets price in rate cuts as soon as next year.
It's interesting thinking about where the market's focus is, and it's been pivoting away from inflation towards recession fears, and then we get a rude awakening yesterday that we still need to think about inflation. With that in mind, though, interesting to see how fast some commodities, Justine, have been falling. And there's a red headline across the Bloomberg right now, says iron ore crashes below $100 a ton amid China property turmoil. And this is coming from sort of, yes, we've been nervous about China for a while, but seeming turmoil in Chinese property markets coming from left field to remind us of risks to growth.
Right, exactly. I mean, we haven't really had a lot of good news out of China lately. I mean, sure, maybe they will step up stimulus, but with kind of COVID-0 not changing, I mean, that demand picture is still, pretty worrying. Of course, kind of on the inflation front, we are expecting to see a bit of help from gas prices coming down, from July onward, probably. But I mean, we have seen from yesterday that there's still a lot of pressure on the services front, on the shelter front.
Yeah, okay, Justina, thank you so much. And that iron ore price there down by 8% in just today's session. Thanks to Justina Lee. And for more market analysis, check out MLIV Go. That is the function to use on your Bloomberg terminal. That's where you'll find the Markets Live blog. They'll be reacting to all of these market moves for you. This is Bloomberg.
City of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions, and those of its two biggest billionaires.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Now keeping you up to date with news from around the world, here's the first word. In Tokyo, the government has raised the COVID infection alert to its highest level. Almost 17,000 infections were reported in the city Wednesday, compared with 3,500 on July 1st. So far, the number of severe infections remains low. The U.S. Senate is getting closer to a deal on President Biden's economic agenda, but the state and local tax deduction issue threatens to spark a showdown among Democrats. Senator Joe Manchin has been negotiating with Senate Majority Leader Chuck Schumer. Manchin says the federal deduction popular in high-tax states known as SALT hasn't been in the mix. That could doom the bill's prospects. And there's another big-name casualty from the $2 trillion cryptocurrency crash. Crypto lender Celsius Network has filed for Chapter 11 bankruptcy protection in New York. Celsius had amassed more than $20 billion in assets by offering interest rates as high as 18% to depositors. It halted withdrawals last month in the midst of a panic run by clients. Coming up, we'll get back to the markets and the inflation picture and what central banks will do about it. Anna Titareva, UBS European economist, joins us. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las mediciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Fed could be on the verge of an historic rate hike. The latest inflation report may push the central bank to consider a full 1% increase this month. Critics blame the Fed for its initial slow response to rising prices. Wall Street traders are raking it in. The biggest U.S. banks are expected to report a double-digit increase in trading revenue. Meanwhile, investment banking revenue likely plummeted. JP Morgan and Morgan Stanley kick off earnings season for the banking sector today. And Biden in the Middle East, day 2. He'll commit to extending an agreement with Israel that provides billions of dollars in military aid. Plus, he'll prepare for that crucial meeting with Saudi Crown Prince Mohammed bin Salman on Friday. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons over in New York. And sentiment pretty weak for risk assets here in Europe, Matt, as we head towards the start of U.S. trade.
Yeah, weak and getting worse. So we have S&P futures that are down more than 1% right now. Investors are selling S&P futures down more and more throughout the session. Although it's been holding here for about a half hour, it was down just 0.8% about 40 minutes ago. The U.S. 10-year yield is rising a little bit. We're up 2.5 basis points now at 295.95. So investors are selling off that debt at least, and that could be what's holding us back from bigger losses on S&P futures, right? If you're yielding more on the S&P than you are in the 10-year. NYMEX crude down $2.60 a barrel to 93.70, so relatively low level for NYMEX crude considering what we've seen lately. That could show you recession concerns, and of course a lot of that has to do with the Fed raising rates at least 75 basis points. That's the consensus now for July 27th, but possibly 100 basis points. Still not like a 5% hike that we saw from Paul Volcker, so not exactly the most ever. Bitcoin right now holding up about 0.4%, 19,731. It's not terribly interesting because it's been at this level, except for the fact that it hasn't dropped lower, right? After a 9.1% CPI report, you may have expected a bigger drop in Bitcoin. Kaylee?
Well, you may not be seeing that much of a drop in Bitcoin, but you definitely are seeing declines in large cap technology again today. Now, there is some specific stories that are worth noting, including for Tesla, its top AI and autopilot chief leaving the company, plus its price target cut at Morgan Stanley to $11.50. That stock is trading around just below 703 this morning, down about 1 percentage point. But of course, also overhanging large cap tech in particular is the prospect of higher rates, a more aggressive Federal Reserve. And as a result, you have Apple, Amazon, Meta, all down in the ballpark of 1% before the bell as well, Anna.
Kaylee, let's have a quick look at what's going on here in Europe. I mentioned to Matt that sentiment had deteriorated, and that's certainly true. We've seen European equity markets under pressure, down by 0.9% on the stock Europe 600. A lot of focus on Italy. We got a report from Rome earlier. We'll continue to monitor these headlines. We've seen confirmation that the Italian parliament is going to hold that confidence vote today, and the Italian FTSE MIB is down by 2.2%. A lot of pressure coming through on Italian bank stocks in particular. We also see the Italian 10-year yield in focus. Those yields on the rise, spreads widening as there's nervousness about whether Prime Minister Mario Draghi will still be in post by the end of today. Let us keep with the economics and think about where we go on the global economic agenda. Anna Sitareva joins us, UBS European economist on set now. Anna, really nice to have you with us. And I'll actually start here in Europe because we've had some news lines coming through about expectations for European growth this year. I know we've got a lot to talk about on the US CPI front as well. But we've got this briefing taking place from Paolo Gentiloni of the European Commission saying that the EU needs to prepare for an economic storm over gas. I wonder what that looks like from an economic perspective. What are you starting to factor in when it comes to the gas taps possibly being turned off? What damage will that do to the European economy?
Yes, I mean, in terms of our baseline, we still work with an assumption that we get high energy prices, but no disruptions in terms of volume of energy being supplied to Europe. However, we recently did an exercise where we laid out several recessionary scenarios, and based on this exercise, we showed that the deepest recession in the Eurozone would be, in fact, caused if we lost all of the gas supply coming from Russia. But even in the case, if Europe, let's say, went into more of a preemptive gas rationing, this would still push Eurozone into a recession.
I mean, the European Commission themselves actually predicting recession for two countries, two in the east, though, and two smaller parts of the Eurozone, Estonia and Lithuania, they see going into recession in 2022. I suppose the big concern is going to be Germany. Is the way that this works is gas flows turned off and there's a cutback in the level of operations from German industry? Is that what's going to be the big factor from an economist perspective?
So I think it's important to flag that the first important step happened when the German government went into the second stage of their gas emergency plan. Now, at the moment, it doesn't mean rationing. It means more monitoring, working closer with network providers, etc. But by moving to the second stage, that also sort of automatically increases risks of moving to the third stage, which would then imply rationing. Now, at the moment, we don't have the details how the gas rationing plan would work, but we do know that under this plan, households and essential services would be protected. So a bulk of this rationing would likely have to be done by the industry.
Is there anything that governments can do on the supply side, Anna, anything that makes you hopeful?
We've already seen some of that happening at the start of the year. We've seen that there was a big increase in LNG imports. We've also seen governments working really hard trying to secure alternative gas supplies. So that's been happening. But at the moment, if we lose eventually all of the Russian gas, that's unlikely to be sufficient.
Okay, so let's talk about how this translates into monetary policy. Of course, we're having a conversation now about the Federal Reserve potentially hiking 100 basis points in a couple of weeks. And we had Gary Schilling on this program yesterday, and he talked about global central banks being a kind of cartel and essentially them all moving together. If you're seeing 100 basis point rate hikes out of the Federal Reserve, what kind of position does that put the ECB in, given, yes, they're dealing with inflation, but the growth outlook is deteriorating rapidly?
Yes, in terms of our baseline, we still think that ECB will start with a 25 basis point hike in July, and then will continue with 50 in September, and then 25 in October and December. We do think that, given all the growth worries, the ECB will still go ahead with hikes over the summer. However, if we end up in one of the recessionary scenarios that I laid out earlier, we could potentially see ECB taking a pause later in the year. But at the moment, we still think that sort of July and September hikes are firmly on the table.
And let's talk about how the currency factors into all of this as well. Paolo Gentiloni, in those remarks he's making in Brussels, now saying that the euro is showing strength, but the dollar is strengthening more. So it's a story both of dollar strength and then also euro weakness. How does a euro at parity factor into your economic outlook, Anna?
Weaker euro is definitely sort of pro-inflationary. We tend to work with sensitivity that 1% depreciation in euro effective exchange rate adds about 10 basis points to headline inflation. If we look at euro effective exchange rate since late June, it's now down around 2%. So it is sort of providing additional worries on the inflation front. So that's something that also ECB said they will take into account. But we also have to remember that given that companies are using some hedging strategies, the impact of weaker currency is likely to feed through relatively gradual.
What about the impact of the yen?
Well, from the euro perspective and from the European perspective, again, this is sort of captured by the effective exchange rate of euro.
Anna, thank you very much. Thanks for joining us. Good to get your perspective. Anna Sitareva of UBS. Coming up on this program, we'll pivot from the macro story to the bank earnings story. The two are linked, of course. Walter Todd joins us, President and CIO of Greenwood Capital. We'll get his perspective on the forthcoming bank earnings season. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Anna Edwards in London. Well, earnings season kicks off in the U.S. today with the big banks. J.P. Morgan and Morgan Stanley both reporting before the bell this morning. Then Wells Fargo and Citi are due tomorrow. Bank of America and Goldman will be rounding things out next week. Of course, investors will be on the alert for comments on the economic outlook as well as the actual headline numbers. Joining us now is Walter Todd, President and CIO of Greenwood Capital. Greenwood Capital owns both J.P. Morgan and Bank of America in their large cap strategy. So Walter has skin in the game. As we look to these earnings this morning, the prospect of maybe boosts on net interest income on trading, but some concern around investment banking and just the broader economic outlook, how optimistic are you feeling?
Yeah, well, good morning. Thanks for having me on. I think I wouldn't say optimistic. I think everybody feels like they're kind of bracing for impact with this earnings season. I think there's a lot of, as you said, puts and takes. Traditional banking business should actually be pretty good, as you mentioned. Net interest income should be up given the rise in rates. Rates have moved higher much faster than a lot of bank executives anticipated at the beginning of the year. On the flip side, you've got housing slowing, you got investment banking slowing, and even the traditionally kind of stable wealth management business has been under fire, obviously, with the market performance. So I think there's going to be a lot of headwinds. But when you look at the valuations, J.P. Morgan was trading at over 2 times book at the beginning of the year, is trading 1.3 times today. So obviously multiples have compressed, expectations are low. So I think you could see, a move higher in these stocks because of that lower expectations. Even with a yield curve that's the most inverted since the year 2000? Yeah, I mean, that's a great point. I think that speaks to the market anticipating the Fed making a pretty big mistake here, going 100 basis points potentially at the next meeting and 75 after that. A mistake, you say? Yeah, well, yes. I mean, they are unfortunately, I think, looking in the rearview mirror and not out of the windshield. And out of the windshield, what you can see very clearly is growth is slowing quite significantly, which has set the wheels in motion for inflation to slow. I mean, I know the number yesterday was very hot, but if you were to look forward 3-6 months, it's clearly going to be, I think, much lower. And so, again, the Fed's kind of looking at that backward-looking data, and they're going to be very aggressive. And the market's telling the Fed, you're making a mistake by being 25 basis points inverted currently. So, yeah, that's a headwind going forward. But I think in the near term, this hike in rates is really, you're going to see a pretty powerful earnings stream coming from traditional banking business over the next several quarters because of these higher rates. Over the next several quarters, but it sounds to me like you're also in the camp that we'll see rates come down relatively soon. I mean, especially if we get into a recession and inflation is under control by, the middle of next year, does the Fed start to reduce? Well, the interesting dynamic yesterday is as you saw the hikes being pulled forward, and this is in the futures market, Fed Funds futures market, as you saw the hikes being pulled forward this year, you saw actually the cuts being pulled forward next year, and the higher probabilities actually all the way going into as soon as February, the market pricing in the possibility of a potential cut. So again, it doesn't really matter what I think, is what the market thinks, and the market's anticipating rates starting to be cut in the middle of next year, and that's really not for a good reason. Inflation is going to be lower, but it's probably due to the fact that growth is going to be much slower as well, that the Fed may have to pivot and reverse course. What else are you looking at in terms of the bank earnings? M&A has slowed down. IPOs are practically non-existent. So investment banking advice is going to be less profitable. Yeah, I mean, again, outside of the traditional banking, loans should be decent, but investment banking is going to be challenged. Housing market is going to be challenged. I think another wild card for this quarter for a lot of the bigger banks is this, the whole CECL accounting and what the expected losses are going to be under that framework. And I think that's very hard to judge at this point. I mean, you're trying to estimate the losses of a loan over the life of the loan, which is very different than you've done in the past. That's hard to do in a perfect world. I think we all agree we live in a far from perfect world right now, so very hard to estimate what those losses are going to be and to project that on these earnings announcements.
Walter, yeah, we'll keep in mind that change in accounting rules then. Walter, you mentioned that when you look through the windshield, you see an economy that is slowing. I wonder if we're going to get clues, or where should we look for clues in the bank earnings story that will inform that view?
Yeah, I think it's really going to be on the commentary. I mean, what's kind of going to be the mood of Jamie Dimon on the call today? We heard from him beginning of June talking about an economic hurricane on the horizon. We got a very different message from Brian Moynihan at Bank of America. So I'm going to be listening very closely to what they're seeing kind of in real time versus really what the quarter they're reporting is going to say. And so that's where I think we'll get the clues. And also, how much are they reserving or expecting for credit losses? What are they seeing in the card business in terms of spending, potential delinquencies there as well?
Okay, so that's where we focus. In terms of the numbers they report, and even if this is going to be a bit backward-looking perhaps, even more so than usual, the trading businesses might do well because of the volatility we've seen in markets, but a lot of people will wonder if that's going to be repeatable, Walter. Will share prices move on trading results, or will it take other factors?
Yeah, they could. I mean, you look at the mix of business. I mean, Goldman traditionally benefits more in that scenario than, say, a Morgan Stanley would or a JP Morgan would on the trading volatility. But I think that's going to be, again, kind of look through to your point and really going to focus in on some of those other core businesses and see what the outlook for those are going forward. But again, it's this trade-off between how much of this bad news, potentially bad news on the outlook is in the stocks at the current levels, and how they react to those earnings and guidance.
Well, to that point, Walter, we have a board up on the screen right now. All of these players are down by 0.25% or more year to date. Are you adding to your positions in the likes of JP Morgan and Bank of America on this weakness?
Yeah, so we have model weights in those names, and as they have come in, we've run what we call run those to model. So we've added to them to get them up to those target weights, but we are underweight financials and banks currently. I don't see that changing in the near term right now.
Walter, thanks so much. Thanks for joining us. Walter Todd of Greenwood Capital. Coming up later in programming, we'll get reaction to the JP Morgan earnings and to that earnings call, perhaps. What will Jamie Dimon say? What will his characterization of the threats to the U.S. economy be, given his talk of hurricanes in the past? We'll get some analysis with Gerard Cassidy, RBC Capital Markets Head of U.S. Bank Equity Strategy. That's at 6:30 New York time, 11:30 here in London. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. Tom Keene joins us now, co-anchor of Bloomberg Surveillance, to talk about the show ahead. And Tom, the Japanese yen at the weakest level since 1998. Janet Yellen yesterday in Asia saying we let markets take care of currencies, but that's until we don't, right?
There are no less than 20 charts I could show this morning, Matt. Markets are unraveling. There's no other way to put it. Something as obscure as Singapore dollar versus Thailand baht is extraordinary. This is the most zombie-like chart I could find. I have never seen a chart like this. This is dollar yen back before 1998 with the weaker yen, the red circle of the sweat of August of 1998. And we're getting there, which is a big deal. But what's far more important is the lethargy. Notice how the series in 1998 is jagged, it's got drift, it's got trend, it's got something the quants call Brownian motion. Now it doesn't. It looks zombie-like, lethargic. There is no life to the weakening of yen. This is absolutely extraordinary and one indication of what you see out there this morning.
And are you going to be talking about that with Margie Patel, Allspring Global Investments Senior Portfolio Manager, Tom? What else is going to be the
she's legendary, and we're going to talk to her about what do you actually do with your money. And one of the things you do is you pause and listen to what James Dimon and Mr. Gorman over at Morgan Stanley are going to say. J.P. Morgan and Morgan Stanley are living this in real time. Sonali Basak told me that the VAR, the value at risk, will be of interest, and we'll do that. Gerard Cassidy helping out.
Yeah, really looking forward to the breakdown of those results. Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. And on that point, that's what I'm watching today, U.S. bank earnings with J.P. Morgan and Morgan Stanley. Guys, it feels to me that every positive thing the banks have going on, there's also a potential negative ramification of that. You think about the prospect of higher interest rates. On the one hand, that helps on net interest income. On the other hand, does that actually slow down loan growth and things like mortgages? Then you have trading that could do really well given how volatile markets are. But what does that do to deal-making, investment banking fees, considering there aren't many companies eager to come to the public markets when they're as tumultuous as this? And we've seen M&A activity slowing down. And then really that hurricane forecast from Jamie Dimon is what I'm going to be watching for on these conference calls, Matt. What do they say about the health of the consumer, the economic outlook, the risks of a recession? I'm sure markets will be clinging to each and every word from these banking executives.
Yeah, absolutely. We all will. We're also going to be watching PPI, U.S. PPI coming out at 8:30 today, and the last reading was 10.8%. The estimate for today is 10.7%. Clearly, there's a talking point that's been circulated amongst all administration officials to call this unacceptably high inflation. The question is, what can the administration do about it? And we're going to see one attempt to do something about it tomorrow when President Biden visits Mohammed bin Salman. The question is, how unacceptable is inflation as opposed to how unacceptable is it to murder and dismember a journalist? Those two things are going to have to be balanced. Anna?
Yeah, the balance of the economic and the geopolitical very much on show when it comes to that trip to the Middle East. Anne-Marie Horder, and bringing us updates, of course, as that trip continues. I'm watching politics a little bit closer to where I am right now, and that is in Italy. We had confirmation this hour that a confidence vote will be taking place in the Italian government. One of the partners in that government, one of the coalition partners, has said that they might abstain from this vote. And will that end up with the resignation of Prime Minister Mario Draghi, who you see in these images on our screen right now? And that could matter to markets, of course. The actual subject of debate right now is whether Five Star will back the funding of a spending bill which funds the Ukraine assistance. It funds families who are fighting higher costs. But will this result in the resignation of Draghi? And then over to you, President Mattarella. Will you accept that resignation or tell Mario Draghi to go back and try again? And Matt, I guess this matters because we've seen the ability of the Eurozone peripheral story to blow up on occasion and to distract from the tightening agenda of the ECB.
Yeah, absolutely. The question is, which way does it go, right? If there's a real problem in the Eurozone, does that lead to concerns again about a breakup, or does it lead to more of a federalization? And I think a lot of people this time are betting on the latter.
Right, yeah, forged in crisis, often said about the Eurozone. Right, that is it for Early Edition. More surveillance is ahead. Tom, John and Lisa will be taking you through response to the CPI number of yesterday. Plenty of analysis still to come on that. A lot of moving parts, as Tom was telling us earlier on. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Every developed market is facing the same problems in terms of high inflation, slowing growth, declining real wages.
This is going to amp up pressure on policymakers. It's going to be a tough call for the Fed, to be honest.
They let the inflation genie surge out of the bottle much too rapidly.
with their shift to a backward-looking paradigm.
It's going to be a rough road the second half of 2022.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Some big moves out there this morning, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures down a 1 full percentage point. TK, where do you want to begin?
Well,
Stocks, bonds, FX?
It's there. We've got J.P. Morgan and Morgan Stanley, but I'll be honest, John, suddenly they're a sideshow to what's going on in the markets. I thought Larry McDonald and Zero Hedge were the tour de force on John, how EM is catching up with what we see in the developed countries. The idea that the Egypt 9-year peace is down 20-some%. Well, so what? Except all of a sudden it's happening, John. It redounds back to Chairman Powell.
Seeing EM-like moves in dollar yen, Tom. Dollar yen 139 early this morning. We've got the deepest yield curve inversion in the Treasury market, 2s versus 10s going back to the year 2000. This is some big stuff.
It's big stuff. Yeah, that's exactly right, John. That's really well put. It's big stuff, and suddenly it's there. And let's go. We got to get Jean Boivin on as a former deputy governor of the Bank of Canada over what Canada did yesterday. Are they leading the way for the adults in the room?
They went 100. Bramo, will the Fed follow month end?
That is the discussion right now, and currently the market is pricing in about a 50% chance, a 1 in 2 chance that the Fed will go that way. And frankly, the Fed officials who have spoken so far are not doing anything to dampen that speculation. We heard yesterday basically confirmation from the Fed's, Atlanta Fed's Raphael Bostic, basically saying, we'll do whatever it takes. Everything's on the table. This is not a good print. We heard that from Loretta Mester of the Cleveland Fed. The message is clear. They are concerned. This was a terrible CPI report for them.
We want to make sure this morning that we don't get lost in this 75 basis point versus 100 basis point hike story month end. The debate has got to be much bigger than that. I've put this out on Twitter this morning. We've got to ask the following questions. Is there evidence from the June CPI report that this is stickier and broader and with us for longer? And with that in mind, Tom, are there upside risks to the hiking cycle in the second half of this year? Because there are two camps right now looking at this market. The number one camp at the moment is you look at June, you say energy's going to fade, that's the worst of it. Then number two, you look at June, you say this is stickier, look at Schauter, this is going to be with us for longer, the Fed will have to do more. That's going to shape your view on this market. It will shape your view on this Fed in a much bigger way too.
Yeah, nicely placed, John. And what I would do off the research notes is suggest the people that focused on shelter not so much said the other side is wrong, but that we're ever more data dependent now, and that data dependency, used cars move, but you know what? It is about shelter is a broader statement.
Let's get into these markets. We are down by 1 full percentage point on the S&P 500. On the NASDAQ 100, we're down 0.9%. Euro dollar, a clean break of parity yesterday for the first time since 2002. We have a weaker euro on our hands. Weaker currencies across the board, just a stronger dollar, rip-roaring US dollar through the year so far, and on the session this morning too. Yields up 3 basis points to 296.50, and Lisa, there it is again. Get used to this. We might be looking at the 80s pretty quickly on crude. WTI $94, and Lisa down another 2.3%.
It's really surprising, especially given some of the analyst calls for the tightness of the oil market, considering the fact that this has been one of the main drivers of inflation. How quickly can it come down to actually alleviate some of these pressures, and is it enough given how broad-based, exactly as you were saying, John, the CPI report showed the inflationary winds are today? I know this is something very special for you, John. J.P. Morgan and Morgan Stanley earnings and earnings calls are going to be rolled out, and this is really kicking off the Q2 earnings season. I want to understand how the Jamie Dimon, we're facing a hurricane kind of statement, translate into the tea leaves of what they're actually seeing at a time when the GDP now of the Atlanta Fed does show a negative read for the second quarter. Are we looking at something similar, according to at least J.P. Morgan and their granular data? At 8:30 a.m., we get U.S. initial jobless claims and U.S. June PPI. PPI I'm actually more interested in than initial jobless claims, although both very important to give an ongoing current read to really give some color to the CPI report. With the PPI, how much do we see materials continuing to increase, those input costs that will continue to pressure margins at a time when we are seeing consumers become a little bit more sensitive to price? And at 11:30 a.m., our own Michael McKee is going to be moderating a discussion with the Fed Governor Chris Waller. Very curious to hear how he talks about where the market is currently pricing in interest rates at the end of the year. And John, to your point, it is not about 100 basis points or 75 basis points. It's what happens after that and after that and after that. And right now the market is pricing in a 3.7% interest rate at the end of this year, really bringing forward some of the forecasts from earlier.
That is the big debate taking place on Wall Street right now. Bramo, thank you. And again, looking forward to Mike McKee sitting down with Governor Waller a little bit later on today. Joining us now is Margie Patel, Senior Portfolio Manager at Allspring Global Investments. And Margie, it does come down to this for a lot of people. Do you look at June as the worst of it? Energy's going to fade? Or do you look at June as evidence that this is stickier? We've got to get used to this being with us for longer, and this Fed has got to do a whole lot more.
I think that actually we're pretty much near the peaking of the CPI. Yesterday may not have been the absolute peak, but the next month I think surely will. And what I'm concerned about is the Fed focusing so much on the headline inflation. They're losing track of an economy which is losing momentum, real wages which are declining, and pretty much around the world you see economic distress. Emerging markets have debt problems. Europe has very slow growth problems. And I'm afraid if they pursue their typical path of aggressively tightening, focusing on inflation, that they will do real harm to the economy. That's what I think the stock market is telling us here.
Margie, you just said pretty much around the world. You're too young to remember 1998. Unfortunately, Margie, I remember it. And all of a sudden, the correlations click in. How far behind is pretty much around the world? How far behind is EM, et cetera, from what we're seeing in major things we're focusing on?
Well, I think that's a very good point, that when bad things happen, they tend to get clustered and happen all at once, and everything is correlated down. And that almost looks as if we're on the precipice of that with the aspect of what the Fed is going to do. So, yes, I think it's happening more or less simultaneously. Emerging markets have had big problems building for years, and it didn't matter till we had this huge spike in basic commodities. Again, Europe has its own problems with energy, low growth. So this, to me, says this is a time where the market's reflecting economic reality, not necessarily where rates are. Rates will come down on inflation as we see a much slower economy.
Margie, based on what we have seen with the CPI reports, and perhaps not what the Fed should be following, but what they are following, have you changed your positive outlook, particularly on risk assets?
A little bit, yes, because it seems that it's going to be unavoidable to not have a real earnings slowdown. I think it'll be interesting this quarter. I think earnings will be pretty good or surprisingly good, but their outlooks for the rest of the year, I think, may be much more guarded, and I don't think the market's going to like that. I think it all rolls back to the economy's losing momentum, and the Fed is aggressively tightening. They're looking in the rearview mirror, and it seems like they want to repeat the mistake they've made in other cycles.
Margie, when it's like this, what do CFOs do? Do they issue more debt? Do they use this as an opportunity?
Well, they have been doing that over the last few years. They really have taken advantage of near zero interest rates. Investment grade companies that don't need the money at all, like say an Apple, and also junk companies have also aggressively raised cash on their books, so their balance sheets are very strong, so they won't be cut off by the banks, so they can ride through a downward cycle in the economy. So corporate America really looks pretty good because they've already done that borrowing.
Margie, good to catch up. Margie Patel there of Allspring Global Investments. Would a sell-off be complete without Italy? Let's look at the Italian bond market. Yields up 24 basis points on a 2-year, on a 10-year up 21. And a conversation, Tom, about a confidence vote a little bit later in Italy and the prospect of the Italian government collapsing, going into a massive week for Europe with the ECB on deck and Nord Stream 1 coming back online, scheduled to come back online next Thursday.
Our Rome Bureau is some real good work on that with Caroline Look as well. And John, what is the ramification if Draghi is not pushed out, but just if Draghi's not renewed, if you will, to Italy?
The technocratic government collapses, Tom, and then we're into the unknown. Who takes over? And the reason the ECB is important next week is because we've all talked about this anti-fragmentation tool for so long. And Lisa, what does that come down to? Supporting the Italian debt market. For many people, that's exactly what it is.
And that risk only increases, making it that much more challenging for the ECB to actually affect that. All of this really pinned, and when you mentioned the Nord Stream reopening that we're expecting, or at least is scheduled, it really hinges on this. It basically indicates how much the ECB will be forced to raise rates, pressuring that dynamic and removing some of their support for the Italian bond market. I mean, talk about the butterfly effect.
Sure.
That's what it feels like.
Can you define what is a warranted tightening of financial conditions when you're raising interest rates and what is an unwarranted tightening of financial conditions? I guess that's in the eye of the beholder, and the ECB gets to decide.
what is warranted, what is unwarranted. If their view is inflation, it's warranted. If their view is employment and stability and longer-term economic prosperity, well, that's kind of out of their remit when you take a look at where the inflation rate is. And that is the conundrum that the Fed is struggling with as well.
Well, you bring up the Fed. I liked what Neil Dutcher of Renaissance Macro has said recently about the Federal Reserve, Tom, that ultimately, yes, there's some kind of framework there. We can all try and get our hands around that. But over the last few months, this chairman has basically made a move and then picked a data point to support the move. And I think he did that with the pivot too. He said it was down to the ECI. Then he said the difference between 50 and 75 was you, Mitch. So if you're debating with yourself whether we get 75 to 100, it's whatever data this chairman wants to look at ultimately and make the decision.
I agree with that. But what we reaffirmed yesterday is how data dependent these central bankers are. A couple ideas, John. And folks, I can't emphasize enough how odd the markets looked this morning. Again, I think Larry McDonald's article in Zero Hedge was absolute tour de force on the EM issues out there. John, Jerome Powell is central banker to the world with a vengeance this morning.
Shall I reach out to Larry? Would you like to get Larry on?
Well, I always want to talk to Larry, but I want to say that Powell is central banker to the world ever more likely this morning. And the other thing I'd say, John, is the behavior of Japanese yen is absolutely original. I've never seen it. How does this yield curve control model work, given the cacophony right now?
Grandma, final word.
Final word is that everyone has been surprised by inflation and central bankers have been humbled by their past mistakes in understanding it. And that is what we're hearing from how they are reading the current incoming data.
My final word, John, is it's 768 miles from Frankfurt to Rome. We go over, we do ECB, and then get on an elephant and go back down to Rome.
I was giving Lisa the final word.
Oh, that's my final word.
Am I coming with you?
Yeah, of course. Okay. I mean, we take an elephant to Rome and we do the show from Rome.
I don't know why we're getting an elephant. We're down at 1% on the S&P from New York. It's the least of my problems this morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Officials at the Federal Reserve may debate a historic 1% point rate hike later this month. Atlanta Fed President Raphael Bostic told reporters that everything is in play after U.S. consumer prices rose a faster than expected 9.1% in the year through June. Investors bet the Fed is more than likely to hike rates by 100 basis points at the next meeting. In the UK, another round of Conservative Party balloting is set for today in the process that will determine the next Prime Minister. The field of candidates has now been cut to 6. Former Chancellor Rishi Sunak and Trade Minister Penny Mordaunt have emerged as the frontrunners. At least one member of the field will be knocked out after today's vote. President Biden is committing to extending an agreement that provides billions of dollars for the Israeli military. The president is in Israel and met today with Prime Minister Yair Lapid. The two leaders are calling for an extension of the agreement that now stretches through 2028. And there's another big name casualty from the $2 trillion cryptocurrency crash. Crypto lender Celsius Network has filed for Chapter 11 bankruptcy protection in New York. Celsius has amassed more than $20 billion in assets by offering interest rates as high as 18% to depositors. It halted withdrawals last month in the midst of a panic run by clients. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Season is here.
It's a low bar going into earnings season.
There are bargains out there to be had.
Bloomberg is fastest with the numbers and analysis.
There's conflicting and complex cross-currents. Strap yourself in for this earnings season.
Bloomberg, the fastest numbers and analysis you trust.
We're moving toward a 2.5%, what the long-run neutral rate is. My own belief is that we're going to need to go beyond that and well beyond that because, right, inflation and inflation expectations are higher than 2% now. So we're going to have to keep moving.
Loretta Mester, the Cleveland Fed president, weighing in after the CPI report yesterday evening from New York. Good morning. Here's your price action now. Down 39 on the S&P with negative 1.4 percentage point on the NASDAQ 100, down 0.9%. Into the bond market, yields just a little bit higher, 296.32 on a 10-year. Curve inversion, the story there. Euro dollar, a break of parity yesterday. Dollar yen, a break of 139. Just some monster moves taking place in foreign exchange. Big moves in crude too. 93 handle on WTI, 93.98, down 2% on the day. On the month, we're down more than 20% on WTI, Tom. Quite a move.
Yeah, you've mentioned that twice, John. I'm glad you mentioned it. I mean, it's there, 124. We're down almost $30 on Brent crude. I mean, it's really an extraordinary move. John, what do you see in Europe? I mean, nat gas, has it really pulled back? I mean, is it still a crisis for Germany?
This all comes down to Nord Stream 1 next week, Tom.
Yeah.
Without a doubt, it comes down to the ECB, and you can throw in Italian politics for good measure too. It's messy. It's really messy.
Right now, we're going to go to Anne-Marie Horton in Jerusalem with the President of the United States. It is a president at the beginning of a trip in the Middle East. And Anne-Marie, I want to educate the audience here and myself that Jeddah is not Riyadh. The president will fly down the Red Sea over on the western shore of Saudi Arabia to their commercial hub. What will we observe when he lands in Jeddah?
You know, the president is going to be greeted by a very different Saudi Arabia than the last time he was there. I believe the last time he was there was in 2011 when he was vice president. And having myself gone to the kingdom a number of times, whether it was Jeddah, Riyadh, or Dhahran, it has changed dramatically. The last time I was there was before lockdown. I was in Riyadh and Dhahran, and you just see the social changes on the street. And I probably feel them a bit more acutely as a woman. The first time I ever went to Saudi, you know, I wore traditional Saudi dress and abaya and a headscarf in public, and now you don't have to. So there's massive social changes taking place. And this is really the dichotomy of Mohammed bin Salman as a leader. His population is very young, aggressively young. You have women entering the workforce very quickly and excitingly so. Many of them are actually Uber drivers. The last time I was there, all of my Uber drivers were women. And at the same time, that is something the United States would like to see. But they have a lot of human rights issues. The United States has with dissents and critics against the kingdom. And of course, there was Joe Biden as when he was campaigning, saying he was going to make the kingdom a pariah, and revealed that intel report that said Mohammed bin Salman himself signed off on the killing of Jamal Khashoggi.
Is the oil prosperity filtered down to the people of Saudi Arabia? Can we say for the people it's a boom economy?
We can say that, certainly so. They have done very well in terms of Aramco and these higher gas oil prices we have seen. They're exporting an incredible amount of fossil fuel products. We should note that it is a very young economy, and is why Mohammed bin Salman has this Vision 2030. He wants to diversify. This is one of the pillars the Saudis want to talk about outside of the traditional security for oil. They want to talk about investments. They actually do want to talk about cleaner technologies. They want to make sure that their kingdom is built for the future, because they have a very growing, very young population. And they do see the writing on the wall that at some point the world may be moving away towards fossil fuels, even though we're not feeling that right now.
Anne-Marie, how much is President Biden working in coordination with Olaf Scholz of Germany at a time when Nord Stream 1 and the closure, the routine closure, but the question around the reopening really is the dominant story and is becoming an increasing international security and an economic story, not only for Europe, but also the rest of the world?
The administration has been focused on this for months. The president's energy whisperer, his security advisor, Amos Hochstein, talked about this last fall. He said Europe needs to get very serious when it comes to energy security, or they're likely potentially have issues in terms of conservation and potentially freezing. We have heard this from executives, the French executives of Total, EDF, telling consumers, telling businesses they need to start ratcheting back on their consumption now. The issue, of course, is they want to try to build these stockpiles in the summer because they are incredibly worried about the winter. And a lot of this, as Jonathan said at the top, comes down to what happens next week with Nord Stream 1. How much of politics is Putin willing to play with energy, given the fact that it is still the lifeblood of his economy?
AMH, great to catch up. Anne-Marie on the ground. We'll hear from her all week. Just working with my producer Jamie to get hold of this Bank of America note. Savita Subramaniam has just obliterated her year-end forecast on the S&P 500. 3,600 down from 4,500. This off the back of the work of Michael Gapin, who runs the economics team over at B of A now, who's looking for a mild US recession starting in the second half of this year. So they come down to 3,600 from 4,500. They say that's a 25% decline. They point out that 31% is the average decline amid recessions. I'm just working through the notes, Tom, but we were looking for some downgrades, and there's a monster one.
They're going to be there. And to me, the partition when times get tough is profit. And we're going to see that with J.P. Morgan and Morgan Stanley today. The quality of their profit will be interesting. I'm fascinated to see how Morgan Stanley does. Their wealth management margin, John, is legendarily wonderful. It'll be interesting to see if they sustain that.
Lisa, your take?
My take is that the big determinant of what makes a bull market versus a bear market, or gains versus losses, is what Marky Patel was talking about, which is a Federal Reserve whose hand is being forced. The data is not cooperating with them. There was a hope for the soft landing to be facilitated by a natural rollover in the inflation data, which is not happening. So how much are you going to see this be the pivot point for a lot of these downgrade revisions to a lot of the estimates, and how much is it get confirmed, frankly, by the forward outlooks that we're hearing from companies themselves?
Tom, you mentioned Larry McDonald a little bit earlier this morning. Just sent him a quick message. He's going to join us, so we'll try and get him on in the next hour or so.
We're going to drag his people talk to your people?
I've spoken to his people directly.
That's great.
To try and make that happen for you, okay?
It's just amazing.
His people meaning him.
Me, personally, during the show, live, to make this happen on WhatsApp, okay?
You know, the Telegraph did a thing yesterday on, wearing suits and ties with shorts. I can see McDonald doing that.
We'll ask Larry about that. I'm not so sure about the shorts thing. I've got thoughts on that, but maybe another day, given what's happening.
Have you seen that, like in London? I mean, let's be honest. London, everybody here's wearing a damn Patagonia. In London, they're at least dressing.
Hey, Tom,
are we seeing shorts?
I can't speak for London at the weekend. At the weekend, if the sun comes out, everyone's naked because they've never seen the sun before. They behave that way. So, look, I've got thoughts on shorts and suits. I hate it. I hate it.
Okay. You go with the flip-flops, though?
I hate that, too, and you know that as well.
You get,
I really do.
I can see you doing the prep thing, mattress shorts and flip-flops in the winter.
That
would be John Farrell.
Futures down.
You know, we got to get you, John. I can
S&P.
see you with some chody flip-flops.
Down 9/10.
I'm gonna get some flip-flops
channel.
from Chode.
Shorts and flip-flops.
John
are for
Farrell
the
wearing
beach
Chode
or by the pool,
flip-flops in February.
and they do not belong anywhere else. Okay, are we done?
Public
You
service
done?
announcement.
Crude down.
I'm pulling a tan
Dollar
suit out
stronger.
tomorrow.
I won't be here for that. This is Bloomberg.
Stories about what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Here come the downgrades in a big way. Equity futures negative right now, 1 full percentage point on the S&P. On the Nasdaq 100, we're down 8 or 9/10%. Take a listen to this. Bank of America forecasting a mild recession second half of this year. Savita Subramaniam taking the S&P 500 year-end price target from 4,500 down to 3,600. That is one hell of a price target cut on the S&P. That's your equity story. Here's your bond market picture. 2s and 10s looking at that gap between almost negative 30 basis points in the last 24 hours, just off those levels at the moment, with yields higher at the front end again by 4 basis points, on a 10-year by 2. It's the character of the inversion yesterday that got my attention, Lisa. This simultaneous pop higher in 2-year yields and drop lower in the 10-year yield, and it's pretty clear what that bond market picture is speaking to.
And just to confirm that idea, the 30-year auction that we were talking about yesterday actually was unprecedented in the small share of bonds that dealers took down. Indirect bidders actually took down a record proportion of these notes. Basically, the demand is real. People have confidence that we're going to get back to a low inflation, low growth idea, but how we're going to get there is what's changed, and it is near-term front-loaded rate hikes by the Federal Reserve.
To get there, more hikes, lower growth. That's the story for the bond market. You push all this through the FX market, you get some big changes. Dollar yen had a little look at 139 earlier, 138.94. That currency pair has had a 1 percentage point move again today. That's yen weakness, dollar strength. Euro dollar has new problems. Negative on the session by about 1/3 of 1%. Tom, you can now throw Italian politics into the mix. Stir it all up. That is a toxic recipe for what's going to take place in Europe.
Well, I agree for Europe. That's something to focus on, and maybe that is the thermometer of what Madame Lagarde has to deal with, John. But we have moved in the last couple of days, and particularly with Bank of Canada yesterday, beyond just focusing on Europe. What's different this morning with the yen weakness is this has gone global.
So, Tom, for the ECB next week, what do you think they should do? People expect 25. We're looking at the mess right now with Nord Stream 1. If I was in that news conference next week, I'd ask a really simple question. What does the rate hike today achieve?
I would say...
What does it do?
I would say to Christine Lagarde, keep every bit of degrees of freedom open. She needs it. The word she would use is optionality. Has to be treasured here because it's vaporizing rapidly with diminished demand, diminished economic growth.
They've used 2 words. One is optionality, the other is gradualism. Do you lose that second word, Tom, as you look at the world around you?
Their political calculus is so different than, you know, Ottawa's not Frankfurt. Can I go with that? I don't know where either are on the map, but, you know.
You ever been to Ottawa?
I have never been to Ottawa. I almost went once. I was supposed to give a speech, but it was
Why
too
didn't
cold.
that happen?
It was too cold.
Too cold, so you can't.
Plus, I said I wouldn't go unless Montreal was playing the Senators.
Let's hope they're not listening today.
Yeah.
Okay.
Are we done?
We're done. We're very done.
Joining us now to get us started on bank earnings, someone who's been doing this for a few years, a few cycles. Gerard Cassidy is with RBC Capital Markets. Gerard, what is the distinction as we begin with JP Morgan here in 12 minutes?
Tom, I think what the distinction will be is the following. You're going to see some very strong net interest revenue growth from JP Morgan Chase and its peers due to the rise in interest rates that we've seen over the last 3 to 6 months. Second, you're also going to see a big focus on credit quality. That is the concern everybody has about the banks. That is what is weighing on bank stocks, is the concern of credit quality going into an economic slowdown and/or recession. And then third, investment banking results. As you know, Tom, you've seen the numbers so far. They have been very weak this year in the investment banking business.
Gerard, if we get the microphone up, there we go. Gerard, what we've heard over the last few weeks from Jamie Dimon is that this hurricane was coming. Now, I just wonder if you expect to see that in underwriting standards at all from any of these banks.
John, it's going to be interesting. So his, forecast for a hurricane, that's going to be interesting to see if he maintains that or if he upgrades it to something more severe like a tsunami, which would not be good for the bank stocks. On the other hand, he may walk it back a little bit. However, on the underwriting specifically, I would say that the banking industry, as a result of the stress tests that they go through every year and the lessons they learned in 08-09, underwriting standards today are much better than what we saw in the 2006 and 2007 time period. I would also suggest
I think we just lost that. Gerard Cassidy there of RBC Capital Markets.
That's sort of like... That's
suggestions, Tom.
Yeah, that's JP Morgan Securities stepping in, cutting off Cassidy. That's what that is.
Try and get some of those suggestions, shall we?
Let's go to the press conferences. They have 2 press conferences, John. They're both going to be equally important.
Earnings calls, Tom.
Whatever you call them. Excuse me.
Call them a presser if you want. By all means.
Presser.
With analysts.
But John, they're going to be they're going to be more interesting than normal, I guess is how I'd put it.
I would agree with you, but that last question, Lisa, is the one that a lot of people want to see answered. It's all well and good sitting there and having that fireside chat about the hurricane on the horizon. We want to know what's going on in the business, what's happening with lending, what's your read on consumers right now? How strong is this economy? Because we've heard from banks repeatedly that things are decent.
And how do you actually expand in lending at a time when you're worried about consumer credit or even corporate credit in the face of recession? How do you expand some of the revenue bases of the nuts and bolts of what you do if you don't have that faith, if you think that a hurricane is coming? The expectation that investment banking and deal making is going to be a lot slower. Trading will try to plug some of that gap, but the loan creation is really my question. How much can they actually capitalize on higher rates, especially, and it's not really that economic for them considering the flat yield curve.
I've got a man that you can ask if you like. Gerard Cassidy of RBC joined us right now. Gerard, I asked you that question about underwriting standards and credit and the availability of credit and what these banks are going to do through this year. Can you pick up on that again?
Sure. And in fact, John, what we saw in the H8 data on credit creation, loan growth for the banking industry today is at double-digit rates of growth. It's being driven by commercial loans and consumer loans. So we are seeing the banks benefit from this loan growth. And then on the underwriting, as you pointed out, John, that is a critical part in any bank. And the underwriting standards, we believe, are quite healthy or strong. We have to remember, because of what we went through in 2008 and 2009 and the DFAST test that was created following that period, the Federal Reserve has de-risked the banking industry's balance sheets and has pushed some of the highest risk loans into the shadow banking market. And that's where the real issues could percolate should this economy really slow down over the next 12 months.
Gerard Cassidy, at the University of Maine in Orono, there is a great black bear. It's a giant statue, folks. And the statue was renamed in honor of Gerard Cassidy, VAR. VAR the bear. Well, VAR's the bear, and there's a lot of volatility now. You and I don't believe in VAR, Gerard, but the banks have to use VAR. Does VAR matter this time around? Value at risk on how they're measuring their losses?
In the securities area, Tom, it does matter. In the investment banking, trading businesses, trading in particular, it does matter. Now, the banks, again, have done a very good job following 08-09 in managing the VAR for their securities business. So it does matter. And we haven't really seen it get out of hand like you saw during the financial crisis. So I would say that because of the lessons learned in the past, it's much better today. The system is safer. There are still risks. I don't want to dismiss that there aren't risks, but they're just not as potentially as severe as what we saw, of course, in 08-09.
And it seems like a lot of people have accepted this story, Gerard. I don't think a lot of people are looking for intense credit risk at the banks. They're not looking for severe losses. They're looking for where is the growth going to come from in a scenario where they have stripped down so much of the risk, where they aren't necessarily exposed to the upside gain in a sort of bull market coming out of a recession. What are you looking for in terms of areas of growth?
Lisa, we're looking for the areas in traditional lending. I think what we're going to find is it's the traditional banks that are growing their loan books. And what's equally as important, and Tom may remember this because it's going back 15 years now, the right side of the balance sheet, the liability side of the balance sheet finally is going to come back to be the real positive for banks. And what I mean by that is core deposits are going to be very important over the next 12 months. Over the last 15 years, it didn't matter where you received your funding because rates were so low. That is going to change. If the Fed funds rate a year from now is close to 4%, cheap consumer core deposits in Buffalo, New York are going to be more valuable than the high net worth deposits in Fairfield County, Connecticut.
Are you telling us that we're not getting interest on our savings anytime soon, Gerard? Ultimately.
John, that's exactly right. And what's going to happen is that the mom and pop, grandma and grandpa accounts are not going to go to Marcus for 150 basis points. They're going to stay where they are. Plus, on top of that, think of all the people that have direct deposit of their paychecks into a deposit account.
Yeah.
Bank of America has incredible consumer deposits, and they're going to benefit in this rising rate environment. That's why the margins, it's going to be amazing this year how to see this margin growth. We haven't seen this in over 15 years.
And John, this reminds me of when Cassidy was at the University of Maine. It was, he was up on Mount Katahdin and he found Jeff the Black Bear.
Jeff the Black Bear.
And they were playing Colby College in football, and Cassidy brought along this little baby bear, and that was the start of the Black Bear.
Can you translate this for everyone? What are you talking about?
We're talking about one of the great symbols of New England, the Black Bear statue at the University of Maine, hockey dynamo that it is.
Great. Well, it's good. I'm pleased you translated that. Jared, thank you. Jared Cassidy of RBC Capital Markets. Jared's got something to say, but they muted his mic, Tom. So
That's like what they do with me. Why not?
I wish they did more of that sometimes.
Thank you.
JP Morgan numbers, Tom, a few minutes away. You are not getting that interest on your earnings anytime soon.
Yeah, I will re-emphasize that we underreport the size, the scale of these enterprises. Yes, there's a recession, gloom, etc. These banks are ginormous, and John, they're wickedly profitable compared to what Gerard Cassidy remembers in the time of leverage.
So big question, Tom. Lisa, why is the stock down 30%? JP Morgan's down 29% this year. Think about the start of the year, the big consensus call, rates are going up by the banks. Look at how that's turned out.
Where is their growth going to come from? I keep going back to that. If you can't expand in lending, if you're not necessarily benefiting from a yield curve because it's inverted, and if you're looking at a potential credit risk issue, not necessarily collapsing the bank, but just in terms of torpedoing certain profits, it's hard to get excited, and I think that's the issue.
Lisa's asking the same question. You can see she's fired up about it. Where's my interest on my savings? That's what Bramo wants to know.
Absolutely. Actually, there are a couple places starting.
10 years, Tom's thinking the same thing. Futures down 1% on the S&P. We're down 38 points. From New York, JP Morgan earnings coming up shortly.
With the first word, I'm Ritika Gupta. Donald Trump reportedly is looking at announcing in September that he'll run for president again. That is according to the Washington Post. The newspaper says that allies are telling the former president that announcing before the November midterm elections will drive turnout to help Republicans take over Congress. The U.S. Senate is getting closer to a deal on President Biden's economic agenda, but the state and local tax deduction issue threatens to spark a showdown amongst Democrats. Senator Joe Manchin has been negotiating with Senate Majority Leader Chuck Schumer. Manchin says the federal deduction, popular in high tax states known as SALT, hasn't been in the mix. That could doom the bill's prospects. And the U.S. House has passed a bill to help state and local governments set up a warning system for active shooter situations. The legislation gained new urgency after shootings in Texas, New York, and Illinois. Many Republicans opposed it, calling it an encroachment on the rights of gun owners. And a new forecast says the euro area's rebound from the pandemic will be weaker than anticipated. Meanwhile, inflation will be faster because of the war in Ukraine. According to draft projections by the European Commission, GDP will likely rise 2.6% this year and 1.4% in 2023. Inflation is now seen averaging 7.6% in 2022. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Getting some JP Morgan numbers for you. Let's start there. Revenue coming in just a little bit lighter than expected, 31.63 billion. The estimate 31.97 billion. I'll give you the breakdown and show you where some weakness is right now. Equity sales and trading revenue is where the beat was. The miss, investment banking revenue, big miss there. Fixed sales and trading revenue, big miss there. And here's a headline from JP Morgan. We have temporarily suspended share buybacks. The stock is down by 1.44% in the pre-market. It's down on the year by about 30% now, Tom. So some real misses there in the mix from JP Morgan.
Jamie Dimon mentioning here they performed well. He mentions credit discipline. And John, what a shock. There it is, the Fortress balance sheet, front and center for Mr. Dimon.
Not the story for us this morning, though, Tom. Down 3%, Lisa. Miss in a lot of places.
And there were some misses expected or weakness expected, particularly in the investment banking, but not in the trading. And the fact that fixed income trading actually missed estimates, with revenues coming in at 4.7 billion versus 5.1 billion, highlight the tenuous nature of this particularly volatile area. What is going to be the message from temporarily suspending share buybacks if that was also a ballast for a lot of the value that people saw in these shares?
The quarter included a $428 million net reserve build. So at first blush, if you're looking for a hurricane and you're not sure what that hurricane might look like on the horizon, I think these numbers might speak to that. Shonali Basek's had a chance to read through it in some detail. Shonali, your take on things?
Yeah, fascinating here, John, because you were looking for trading to come and save the day. And even though you did see that boost in fixed income, it's not anywhere near what Wall Street was expecting. And remember, JP Morgan, with currency volatility, with fixed income volatility, they are the 1,000-pound gorilla in the room here. So how does that fare then for Morgan Stanley and Goldman Sachs and Citigroup, which were also hoping for trading to save the day? The equities beat was interesting because, as you know, Morgan Stanley is typically the leader in that business. There's a lot of question happening around on Wall Street on whether JP Morgan and Goldman Sachs are truly taking share, especially in the wake of Archegos. Remember that it feels like a long time ago. But again, JP Morgan has been investing in that business while you see they're cutting in other places. They were the first bank, remember, to start cutting headcount in the mortgage business. The charge-offs are also interesting, and the provisions for loan losses came in a little bit higher than Wall Street was expecting. The caution here, especially those suspension of share buybacks, Sachs will be notable and will set the tone for everybody else, including the rest of corporate America.
And Shonali, including the rest of the banks, and I was looking at the knee-jerk reaction in Bank of America and Citigroup, and to follow on to what you're saying, we really are seeing a knee-jerk response that this is the bellwether for the rest of the banking complex and beyond. How much is that accurate? How much has that been borne out in previous earnings cycles, that this really has been an accurate read on the tone for the rest of the season?
It certainly is. And remember, I would also point out that JP Morgan and Morgan Stanley are right now the most expensive of the big banks, especially when you look at it in terms of price to book. They're trading at 1.3 and 1.4, where Bank of America is barely trading at book value. Goldman Sachs, Citigroup, and Wells Fargo are below that. So if this is the bellwether, then there are major questions, Lisa, on how much worse it could get.
The stock is down in the pre-market by 5%. Shonali, you're going to pick up on this story through the next hour when we get Morgan Stanley as well. We want to touch base with Jared Cassidy of RBC, who's had the chance also to go through some of this. Stock's down 5%. I want to go back to those words of Jamie Dimon in the last few months, Gerard, when he said a hurricane might be coming. We don't know how big it's going to be.